The world's largest economy, the United States. CPI Wednesday, PPI coming out on Thursday. Your bond market's shaping up as follows. Let's slice and dice the yield curve up. 2-year, 10-year, 30-year. Look at twos. Your 2-year, 490.82. Your 10-year still north of 4%, with a big move last week, Tom, of more than 20 basis points higher on a 10-year.
On the vanilla spread, comparing the 2-year yield to the 10-year yield, we've really come in. We've disinverted from a negative 105, negative even 111 basis points, a full percentage point difference higher 2-year yield, lower 10-year, into 86 basis points. So there's been, I think it's been underreported this week, except by Katie Greifeld on the real yield. I mean, there has been disinversion.
Great show. Look out for that. 1 p.m. Fridays. Even now on a summer Friday, which is impressive stuff from Katie.
It is. Falling on a sword. You know.
Good for Katie.
It's doing well.
Great show. Look out for that. 1 p.m. Eastern Time on Bloomberg TV. Bloomberg Real Yield with Katie Greifeld. I want to finish on FX away from the bond market for a moment before Lisa gets you some single names. Your FX market just below 110 on the euro against the dollar, 109.57. We're negative 0.1% on a single currency. The euro actually, Lisa, last week showing a bit of strength to close out the week, even with high yields on both the 2-year and a 10-year.
A curious development as dollar weakness began to reassert just a touch. I want to take a look at some names that I find possibly more interesting than some of the macro stories. Rivian shares, the electric vehicle maker, up 3.6% in pre-market trading. Now, this is interesting because it has rallied 84% over the past 8 sessions. It has been on a record streak. This comes after the company said that it manufactured more EVs over the past quarter than expected, has shipped first time commercially outside the U.S. Tom?
Is it a meme stock? Is it like the theater stock that was before?
There is some substantial story underpinning this stock that people believe that it can prove to be some sort of significant competitor to Elon Musk.
I mean,
it has always felt that way.
John, I could just see this. I mean, she's up in the Adirondacks, and the kids are outside the pub tent day trading Rivian.
They look like Ford Broncos.
That's exactly it.
They look
kind
just
of
like
trucks.
a Ford Bronco, yeah.
And I know people who ordered them, but the problem is that people would pay for them, and then they'd get them in 2 years, and then the manufacturing costs. Yeah, so the fact that they're able to deliver more is better.
We've got to stop there, Brown. I'm so
sorry.
No, I'm really sorry. Please. I just think we have to stop this EV climate change nonsense and just call them what they are. I mean, are they good for the climate, for the environment? It's driving me nuts. The branding around this is just incredible. It's so stupid.
You've made an incredible point, which is we have to address the size of a vehicle. And if we're looking for efficiency, it's probably not the best to just put a different kind of battery in if you're going to have, a Hummer. We can get into that discussion later.
Well, we should.
We will. And we will get into that discussion. We should have it.
I
will say.
So much. We'll do that later, John.
That was not how I said it. We will do it later. Alibaba, I wanted to take a look at some of the Chinese shares. They're down about 0.2%. They were down vastly more earlier today in the pre-market trading after the negative data that came out overnight from China. The risk of deflation potentially and slowdown in growth. What's interesting is that there was a feeling that perhaps the veil, the fog of concern was lifted from some of the Chinese tech stocks on Friday. That seems to be at least a little bit eased today. IEP, this is the most fascinating story of the day. The Carl Icahn Enterprise company up more than 9% because the Wall Street Journal is reporting that he has finalized agreements to decouple his loans from the share price of his company. So basically the fear was he had leveraged some of his purchases backed by the shares of his company. The more they went down, the more he could be susceptible to margin calls that could potentially spiral the shares lower. Today he came out and basically said, we've got a stopgap here. We're not going to be doing that. And so you're seeing the shares rise quite significantly.
Lisa, that's like a Wednesday or Thursday discussion. It's too much information from Monday.
It was interesting.
Spinning.
And again, I'm sorry for jumping in.
No, gosh,
just I think, sick to death of us having these expensive EVs shoved down our throat, and we're told to save the world and spend however many thousands of dollars to go and buy one. I just think it's nuts. And then everyone, you see the leaders of various countries get together with the automakers. I understand the industrial policy, and that's really interesting. And I think they're really sexy cars in many circumstances, and perhaps get one if you want one. But this idea you're going to save the world by dumping this kind of cash into a massive Hummer, I don't get it.
I think that the size of the vehicle is very important, and I think you're absolutely right on that. There's a question of how to get the materials out of the earth and what's required to do that. There's a larger discussion that's important to have. I think I take your point.
I'm going to go to Michaelides in 2020. Here's the title of the academic article: Thermodynamics and the Energy Usage of Electric Vehicles. Okay, I got a quality C in thermodynamics. It's really tough stuff. It's really difficult. But I think, to your point, John, there's a lot of questions in the public, in the zeitgeist, not being asked on this.
We'll ask those questions through the next year, I hope. Let's talk about the Fed speak. Barr, Bostic, Daly, Mester. Exciting stuff on the outlook for the Federal Reserve. TD Securities pushing out their recession call from the fourth quarter to the first quarter of next year. Adding, given our new expectation for a downturn in the economy, we now look for the Fed to implement its first rate cut, drum roll, March 2024. We believe the market is sharply underpricing the potential for deeper cuts next year. The longer the Fed keeps real rates elevated at high levels, Tom, the more likely a hard landing becomes.
The calendar, the x-axis, and what we're going to do about it, seriously, about price of bonds. Gennady Goldberg joins us now, head of U.S. rate strategy at TD Securities. Gennady, I want to go to the outcome of this, which is TD Securities reaffirms with a vengeance curve inversion, and we could even get out to a steeper curve inversion down the road. What is the process that gets us to a deeper inversion?
Thanks for having me. Well, I do think that front-end rates remaining quite elevated for a while is what's going to get us there. I wouldn't be surprised to see it. It's been one of the most painful trades this year. I can't tell you the number of clients who've tried to enter curve steepeners here and actually haven't been able to hold on to that trade just because they're very expensive from a carry and roll perspective. What you can see is the front end of the curve continuing to actually move a little bit higher as the market has capitulated to the Fed's view of slightly higher for slightly longer, and that's very painful for the 2 to 5 year part of the curve. That's going to keep pushing up 2 to 5 year rates, and in my mind, could keep the curve actually very, very deeply inverted for at least the next couple of months. And I can tell you, the steepening typically starts about 3 to 6 months before the first cut. At least that's what our research shows. Market right now is pricing in a cut actually even after us. We've got our first cut penciled in for March of 2024. The market's all the way in May of 2024. They're not looking for a cut anytime soon.
Gennady, is that including some sort of trauma to the financial system? Are you basically plotting in this idea that there's going to be some catalyst to that downturn that's going to prompt the cuts, and that's sort of the reason why you expect the deeper and sooner cuts than the west of Wall Street?
Correct. Typically, you do have higher rates acting in some unexpected way. We saw that back in March with the SVB crisis. I wouldn't be surprised to see more tremors in the months ahead. I don't think the market is looking ahead and realizing that higher rates, a real high cost of cash, 5% is not exactly cheap at this point. That tends to put some downward pressure on economic growth momentum. That could actually push the U.S. economy into recession over time. I do think people underestimate how much that can create shocks in the economy over the course of the coming year. I don't think we're quite pricing that in just yet.
Let's say we don't get any shocks, Gennady. Let's say that the economy is truly more resilient to higher rates than anyone previously imagined, and that companies continue to, as Tom would say, adapt and adjust. Then how high should rates go, and how high should they stay for a longer period of time?
Well, I think what you're describing right now is the nightmare scenario for the Fed. They think that they're right near the terminal rate. They're actually dancing around where exactly they want to dial into on the terminal funds rate. If inflation continues to rage,
right,
if there's no real impact on the economy, higher, much higher at that point, and that would be very, very scary. And honestly, the higher you push rates like that, the more likely you are to get downside shocks to the economy, to the financial system. Right. Something on par with what we saw with SVB.
Gennady, people like you talk about the economic consequences of price down, yield up. I mentioned the Bloomberg Total Return Aggregate Index here earlier. It hasn't breached through to new price lows, but nevertheless, it's on the cusp. If we get bonds to go down in price, up in yield on an aggregate, do we get gamma? Do they have an accelerative behavioral tendency like equities where it picks up steam?
Well, you saw that back last year where investors were looking at their bond portfolio and saying, well, what is this? I thought these bonds were safe. You know, I don't think they were supposed to lose value, and they were down a very substantial, at some point last year, they were down quite substantially. If that happens again this year, certainly you can have investors actually selling out. Interestingly enough, the rates are now attractive enough where a lot of investors are going in and saying, you know, even though I think rates can go a little bit higher in the short term,
that connection's back. I thought that connection had gone.
I thought it was good too.
No, you're back. You're back, Kennedy.
Okay, perfect.
Please
I was going to
say
there's a lot of investors who are, you know, really looking at the bond market and saying, you know, these yields are quite attractive. Even if they back up a little bit more, even if I'm down a little bit on my bond portfolio, I'm looking ahead to the next 1 year, 2 years. And that's why actually this year, despite the fact that the aggregate index hasn't done much, you've seen tons and tons of inflows. Right. You've seen over $120 billion flowing into the fixed income space overall, and really not a lot of outflows. So I don't know if there's necessarily that kind of moment that happens with fixed income this year.
Gennady, I just find it fascinating. What's your 10-year yield call quickly here? What's a 10-year yield call out?
Well, as we're heading into the end of the year, we do think things start to slow down. The consumer starts to slow, labor market starts to slow. So we're looking for 3.25 on 10-year rates by the end of the year.
Gennady, appreciate it, and sorry for cutting it. It seems to be my thing this morning. Gennady Goldberg there of TD Securities on the bond market. Slight technical issue at the end of that conversation there, but you know that happens. It's live TV and radio. You know, just warming things up on the technical side. Yeah, just smoothing those issues out.
We aspire to the stability of the Bramocam. You know, I mean, on a technical basis, the Bramocam is just rock solid.
Because it's consistent one note, right?
It's up and running. It's up and running.
There's film in the camera, 16 millimeter.
If you are just tuning in, welcome to the program. Equity futures on the S&P 500, just about unchanged here. We're negative 0.02%. Coming up in the next hour, 8:30 Eastern Time, Steve Rasciuto of Mizuho Securities. He's going to have something to say on the economic data in the week ahead, the bond market, Federal Reserve, and maybe a read on what's going to happen with these bank earnings later this week. I remember, it wasn't too long ago, we were obsessed with regional bank earnings and what that would tell you about the future of the U.S. economy. And no one talks about the sector anymore. Tom, they've moved on quickly.
You know, and I'm going to bring up PacWest here just because I remember the symbol, PACW. And I mean, you talk about dead, it's just like flatlined at 8, you know. It's flatlined. It went from 27 to 8.
I would argue that the bank earnings that we get, including the regional banks, they will become more in focus coming up. As soon as they come out, it's sort of the short-term memory of the market that it will be really important. Everyone will say, oh my goodness, everyone has to watch this. Maybe more interesting than CPI, maybe more telling and instructive for what kind of dynamism there is and how much we have actually withdrawn some of the momentum from the economy. Because right now, we have had lowered expectations. Companies continue to raise prices, I can tell you firsthand. And so how do we see that play out?
You know what's great here, John, is the president drives a Corvette. You think the King of England, when they meet here in a couple minutes at Windsor Castle...
Has he arrived yet?
You think they're going to talk British Grand Prix?
I mean,
you know, the president's got to be into that.
They're going to talk about climate engagement a little bit later on.
Really?
With philanthropists and investors. For those of you interested, later on this afternoon. So...
a lot of people.
Look out for that. An engagement between the President of the United States and His Majesty King Charles III.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Threads, can it get critical mass?
I think it's going to be very difficult to get critical mass. I think right now the name of the game for Zuckerberg and Meta is just further expand the Instagram base in terms of the cross-sell opportunity, eventually advertising. They're trying to strike while the iron's hot, given some of the issues we've seen with Twitter and Musk. But getting to scale is going to be difficult.
Dan Ives of Wedbush, senior equity analyst. The latest tie-up, Meta launching Threads, or rather Instagram launching Threads, but the same thing, going up against Elon Musk and Twitter. TK, you promised some analysis
Threads update.
on Thread.
Here's
What's
my
the
analysis.
update?
They got to get their act together. The news business is in an uproar. You saw it clicking into Saturday evening, Sunday, etc. It's not Twitter. That's the major message over the first.
The review is it's not
Threads.
Twitter. Can you write that
No,
out?
but you can't. It's way too hard. It's way too soft. I got way too many people drunk at parties on Saturday because it's an Instagram feed into Threads. I don't want that. I want to know what our competitors are doing, what the zeitgeist is, and it's not there. They don't want people like the three of us.
Would you like
period.
some more of this? The President of the United States, Tom, just meeting
He's
with
on
King
Threads.
Charles III, Windsor Castle. U.S. national anthem, I'm told, is playing. President's hand across his chest.
Damien from Billions saying "God Save the King" at the Grand Prix. You know,
What did you think of that yesterday? I wasn't impressed by that at all.
No,
That was
didn't do it.
bizarre.
I was going to defer to Mr. Farrow.
Don't defer to me. I'm no expert on national anthems, but that was odd at
This
Silverstone yesterday.
This is really something. And seriously, the tension here, folks, is of course Mr. Biden's affection to Ireland. A little bit of delicacy here. This is the king of the United Kingdom after his, and I may speak out of turn here, after his coronation in Scotland in the last week at Edinburgh. So there's some emotion here.
Just to go through the next few hours, Tom, so the President will participate in a ceremonial arrival and inspection of the Honour Guard with King Charles III. I understand there's also going to be a private meeting with the King at Windsor Castle. Then later, this was the climate engagement story I talked about earlier, Tom. The President's going to participate in a climate engagement with His Majesty King Charles and philanthropists and investors
Off the pandemic,
Windsor
and
Castle.
particularly off the war in Ukraine, has the debate of climate, COP25, 26, 27, et cetera, has it adjusted and changed? And what will these leaders do about a new debate over ESG, a new debate over climate change, still while the war goes on?
And how involved will King Charles be in that effort? We know as the Prince of Wales, Tom, he made a big push on that front.
But you change as king, I believe. You change as president as well. Yeah, the imagery here at Windsor Castle, and of course it brings back, John, the funeral of the king's mother, and late on that afternoon, the final private ceremonies for the family at Windsor Castle. I mean, it's the history of it. It's the history of it away from Buckingham Palace.
We'll step away from some of those pictures now, and if we get any headlines a little bit later on this morning, we'll bring those headlines to you. The President making a stop in the United Kingdom. He'll go from there, Tom, to Lithuania. Then the focus is really going to shift towards all things international relations and NATO.
I'm Maria Tadeo in Lithuania with an important conversation with the leader of Lithuania coming up here on Bloomberg Radio and television. Right now, we looked at technology. Mandeep Singh gives us a brief here, and there can only be one brief, and that is the Twitter Threads mandate. I don't mean to make jokes about this, Mandeep. How unusual is it that one billionaire copies the platform of another billionaire?
Well, so there is a history. If you look at what Facebook has done or Meta has done over the years, they have been very good at copying features or just iterating on their core apps. And they did that with Snap. They've, to an extent, done that here. But look, I think it just goes to show that Twitter as a platform didn't have the kind of moats that you could argue Meta has with the engagement they have on Instagram. And maybe this is an idea for them to, do something similar for Pinterest as well. So it kind of opens the doors for anybody to go out there and experiment with a new app. Now, we know Mastodon and Blue Sky didn't work because they never got the traction going. So in the case of Meta, they clearly got that transfer over from Instagram to Threads, which is why you see that 100 million users in the first week.
Which raises a question of, could it potentially be a Twitter killer, or is it going to be distinct and a separate entity? Tom was talking about how it doesn't necessarily have the same tone as Twitter. I concur with that. I think it's much more chatty, people kind of having to give their take and personality, and much less of, here's the facts, here's the data, let's have an economic discussion. I mean, is that how it's geared?
I mean, it's still week one. And look, I think one change you can see with social media is there is a lot more AI-driven algorithms than it was, before with the user graphs. And Facebook, to their credit, did realize that, as they realized the engagement declining for Core Blue app, they did pivot to AI with Reels, and now they are doing the same with Threads. So the thing about AI is there's obviously a lot going on in terms of innovation, and your moat isn't as strong as it used to be with user graphs, because that was more data-driven. With AI, it's like anything you can do to train your algorithm for better recommendations, that's going to help your engagement.
But how does this really feature into whether this is a Twitter killer? I mean, a lot of people are saying this, and certainly Elon Musk has demonstrated some deep-seated insecurities over the weekend with some tweets. I'm just curious, from your vantage point, do you think that this is truly going to annihilate their business model from a much bigger competitor?
I mean, look, with social media or any consumer app for that matter, it's all about engagement. And if they are able to take engagement away from Twitter, that's going to hurt. And look, the time spent on social media apps isn't growing. User growth has stagnated. So in the end, it's a zero-sum game. And in Meta's case, they really needed something to drive engagement. They tried that with Metaverse last year. I think this is probably the answer for the near term. And they may look for more drivers down the line. But Metaverse, we know, was a flop. This thing definitely is showing a lot more momentum early on.
Just to build on Lisa's line of questioning, it's really difficult to break this out. But Mandeep, we've got a number of new signups to Threads, but I want to understand how much of that is new numbers to Instagram, and how much of it is just people coming over from Instagram and spending some time on Threads. Then the number becomes maybe less impressive.
I mean, you're right, John, that first week it was really onboarding existing Instagram users, but there are network effects. And look, Facebook has 3 billion users across their family of apps. Even if they convert, 20, 25% of their daily active user base, they're probably going to bring over a lot of those Twitter users and more. And that's the power of their platform that no one else has. I mean, Alphabet could have tried to build something similar as well, and they failed with Google+. They probably may be thinking that they could do something similar as well, because there are only very few platforms that have over 1 billion daily active users across their platforms, and they are the ones who can try out a new app and, port over their existing users to the new functionality.
Mandeep, love your coverage and insight on these topics. Mandeep Singh there of Bloomberg Intelligence. What's the number over at Twitter, monthly active users? Something like north of 300 mil?
It's about $330 million.
We're getting close, aren't we?
But it's, exactly. In just, a couple of weeks, you've got 100 million. That's the estimate. The latest estimate, as Mandeep was talking about. If those are active users, is that the end? I mean, is Elon Musk facing $40 billion of useless loans that he's got to repay?
So you'd have to think, Tom, he starts making some changes, starts taking some advice.
Exactly what I thought.
I haven't decided on Threads personally. Another Meta product.
Oh, I have. I don't get it.
But I mean in terms of actually using it in the same way that I'd lose Twitter.
I want to get it. I can't.
The point that you just made there, Meta used to be the bad guy. People were talking about Facebook and Instagram, how they were collecting too much data and had too much power. Suddenly, people are cheering for Threads because they were that fed up with Twitter, which just shows you how fed up with Twitter people have been. But are people concerned about giving one company so much power?
Oh, come on. They want to make it lightweight and fun. They don't want to make it the news organization is. Let's be honest, folks. And our team in the control room, when news breaks, We use Twitter with attribution because it's the fastest thing in the world from legitimate news sources. That's where you learn it as news is breaking. Are we going to say that about Threads?
Don't know.
Yeah.
I mean, I honestly don't know. Just from a personal standpoint, I'm still making my mind up on whether I'll actually... I don't want to be on another platform hosting garbage. Take a walk, get some fresh air, you know,
get some
I mean,
take up golf.
I think, you know, that
I might
bill...
take up golf again. I might start playing golf again, instead of Threads.
Oh,
Yeah, why not? You want to come play with me?
You see me
play
playing
golf, you and I? Yeah, why not?
Get the knicker thingies
What
on.
about tennis, Tom? Bit of tennis?
He's
Wimbledon
great at
inspired
tennis.
you? He's good at tennis.
Yeah, I've seen him inside the park.
Welcome back to another special Wimbledon update for Bloomberg TV and radio from Tennis Channel. I'm Erin Coscarelli. Jessica Pegula rolled into the quarterfinals with a dominant straight sets win over Alicia Sarenko. The world number 4 becomes only the 5th American woman to reach the Elite 8 at all 4 majors. And don't forget, you can watch all the action daily at 5 p.m. Eastern on Tennis Channel. I'm Erin Coscarelli.
From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Langs.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
insight,
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
and analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping, look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
we're calling for a soft landing and not recession.
We're still pretty cautious in terms of whether the Fed can pull off this soft landing.
When it all goes wrong, it's going to go wrong pretty quickly, and that's why the Fed may have to reverse course very, very quickly.
You have to worry that you might be too restrictive for too long.
They're going to end the year closer to 6 than they go to 5.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene all together again on radio and television. CPI Wednesday upon us, and then earnings begin on Friday. John, I'm going to call it a quiescent Monday, but there's this tension in the air.
Got to build on last Friday, Tom. Do you put more weight on the wage growth, more weight on the low unemployment rate, or more weight on the declining payrolls figures we're starting to see? Just a slowdown. We see at the headline.
Lindsay Pieg's, it's no words about it. Wage growth, that's where she's looking.
That's number one.
She's looking number one thing. And you're back to what Neil Dutta, the optimist, has said was, okay, wage growth comes down, but if disinflation, witness CPI Wednesday, comes down even faster, you get flat to actually true wage growth. Will we see that?
That's going to guide your call for the Federal Reserve going into the meeting this month, looking for a hike. Most people are. Then beyond into September, bit of division. Citi say hike. Morgan Stanley say no. And Adam Zettner and Morgan Stanley say no because they think the slowdown you're seeing in jobs, Tom, will persist. And ultimately the bar to get that next rate hike from the Fed after this one, they won't meet it.
TD Bank making clear when they cut out into 2024, they will cut with a vengeance. Lisa, what did bonds indicate to you over the weekend as you came down from the 7-carry Racket River portage?
With lots of mosquito bites. What I'm looking at right now is a market that looks, or at least a bond market that looks very similar to where we were right before the bank crisis, right? We have reversed almost all of the declines in yields, all of the expectations of rate cuts. We have priced them out. We're now pricing in the same kind of terminal 5.4% rate by the Federal Reserve. But stocks are flying. And this is the tension, I think, right now. Can stocks keep rising even if bond yields keep rising as well, even if bonds are saying a very different thing than stocks?
Well, they have done, haven't they? And that's been the difficulty that so many people have had. Yields are up, rates are up, home builders are flying. Let's pick a sector, pick an industry group. The home builders are flying because interest rates are high, so everyone's staying in the home they've got because they don't want to remortgage the house or get a new mortgage. So new houses are doing great and the housing recession's over. Is that right?
That's correct. That's perfect summary. I mean, it just demonstrates how complicated this moment is and how so many people get it wrong. So one guest after another this morning has come on and said they're pushing out their recession forecast. They're getting more optimistic. Right. It's like, and again, we're going back to, this is sort of going back to March 1st. We're back there again.
Yeah.
Within the confusion I see, and I'm going to go back, and this is ancient history, and I don't think it's an equivalent analog. I want to make that clear. I thought Lord Calvasina was brilliant, by the way, in the late 40s into the early 50s earlier. But what we're looking at here in the equity debate, and we're going to do that in a moment, is the second leg of a bull market. The first leg's easy to pick out. At some point, there's enough gloom, boom, up you go. But how do you get to a second leg? And to me, it's January of 1976. It's not that anybody saw 74 coming, or 75, I should say. It was a second leg, John, in January of 1976. Nobody saw that coming.
Are you looking for broader participation going into bank earnings?
I'm looking for corporations to adjust, and earnings once again will surprise. They will adapt.
Nice.
It's a broken record. I'm sorry.
It's all right. Do you want to check the markets?
Let's check the markets. I mean, red and green at the Dow, up 35 points.
Nice. Equity futures on the S&P, unchanged, recovering in the last hour or so. 3-day losing streak, longest since late June, something like that. In the bond market, yield just about unchanged on a 10-year, still north of 4%. In the FX market, not doing much this morning, I have to say. It's a bit of a snooze. The euro, Tom, 109.55 against the dollar.
I was going to say, right now, we're going to get started here looking at the equity markets. Chief Investment Strategist, J.P. Morgan Global Wealth, adjusts as he's adjusted. Thomas Kennedy joins us this morning. What's the key adjustment July 1?
I think your key adjustment has to come back to where you've been since Silicon Valley Bank. In those last, call it 90 days, what has really changed from the macro perspective is that working from home is a pretty attractive opportunity set for people. The supply side of the labor market in the U.S. economy has really improved. Participation rate in prime age, really trying to hone in on historic highs, but we've blown through the pre-COVID levels. But why does that even matter? It matters because your trend inflation level that we really thought we were fighting, about 5% during Silicon Valley Bank, has stepped down closer to 3.5%. So The macro community now has to really adjust to maybe the Fed's not fighting as big of an inflation problem as we thought just 90 days ago.
So what are we thinking about then? 3% is the new 5%, and the Fed's still got to go a little bit higher and growth's going to be okay?
So the Fed, I think, is still in risk management mode. So let's put that aside for a second.
Okay.
But what you have to acknowledge is that the Fed's job is to maximize employment and stable prices. That stable price level has come down. We haven't talked about it nearly as much as we did at the Silicon Valley Bank time, but core service inflation, core services ex shelter has stepped down to 3.5%. That's your best indicator of labor imbalance, and that one in of itself suggests there's a little bit more balance in the labor market.
Let's get to the market call. Is this another way of saying you're bullish?
I think it's another way of saying that the slowdown we are likely to get, 65% of all economists in your survey say there's a recession. It's so natural to believe that that's going to happen. You have interest rates far above anyone's estimate of what a normal time would be. But how persistent does the Fed have to make that slowdown? And if the labor market can come more into balance, they don't have to push nearly as hard. So this risk management mode for the Fed, I think, is part of the challenge that people are having.
But just to build on what John was saying, if that's the case, if we do seem to be having some sort of soft landing, do you pile into the equity trade as a good place to be?
I think you have to recognize what the market's pricing for you and say, where's your opportunity set? JP Morgan Community Wealth Management, one of the biggest pools of wealth assets in the world. 26% of all of our investable assets are in cash and cash equivalents. So we're trying to help people invest for the long term. That doesn't feel like the right opportunity set for them. What's the easiest thing to do? Is to buy fixed income. You buy a municipal bond, it's fine. On the equity side, though, where do you need to reinvest? For our clients, the community is wildly overweight tech, and we can start to find ways to rebalance them. Why? Because the rest of the market is actually pricing in a decent earnings downdraft.
What about the potential that we were hearing from Bruce Kasman, from others, about the vulnerabilities of a market at a time when borrowing costs are substantially higher, and there is a lag effect? I mean, it's unclear how to measure that, but as companies have to refinance, as people have to move, they have to start actually recognizing and feeling the higher rates. How much are you expecting some sort of significant accident to interfere with some of these calls?
I think that risk is certainly elevated, Lisa. I think that's part of the reason why 2/3 of Wall Street think that you will see a downdraft. The question becomes, what do you do in the meantime while you're waiting for that? And equities can rally quite a bit during that time. What can you do to help get your investments to where you need them to be over the long run? And things, if the risk of a deep recession goes down, even if it's subtle, you have to make adjustments in your portfolio.
Right.
And opportunities, private credit opportunities, subordinated bank capital, and more of an equal-weighted S&P angle can help you get there.
There's got to be a huge percentage of people that feel like they missed this. I haven't asked this question. How did 60-40 do in the first half? And can you just stay a vanilla 60-40 forward?
The 60-40 did fantastically well. It was driven, to your point, though, on equities rather than bonds. But again, our clients are underweight bonds. How can I help them renormalize, diversify, Tom, and find a long-run strategic
because
allocation?
They're looking at a total return. I mean, the reality is, here's how they think. They're looking at a total return of, let's say, 5, 6, 7%, and they're looking, granted, S&P hasn't participated, but all their friends own NVIDIA, and they're making 15, 18, 20% blended in a stock portfolio. That's why they're not buying bonds.
Market breadth has been a problem, without question, Tom. Every bull market, though, is a hated bull market. Every time we've been through them. And in this experience, though, I think we're just balancing where we were. I loved your anchor point. We have to go back to where we were pre-Silicon Valley Bank. And that shock to the system wasn't the thing that macroeconomists like me thought it was going to be. We have not seen the material slowdown in lending yet. It doesn't mean we won't get it. But you have to be able to balance out what the risks are, and the risks of a deep recession, I think, are lower than what they were at Silicon Valley.
This is critical. Tom Kennedy's calling this an anchor point. So if Bramo says something profound, we're calling it a Bramo point?
It's a Bramo point.
It's a Bramo point.
It's Bramo's anchor point.
It's a Bramo point.
Oh, boy.
Continue.
Bank earnings Friday.
Sorry, I set you up on that.
Tom, what are you looking for from bank earnings Friday with all of this in mind?
Bank earnings are going to continue to show a challenged outlook. You have, from the deposit side, banks are needing to pay up to shore up their deposits. And on the lending side, you are seeing lending growth slow. But remember at Silicon Valley Bank what we thought was going to happen. Small banks would slow their lending materially. and it's been the opposite. Large banks have slowed their lending materially. It's keeping all ourselves honest here. It is different, but the outlook for the economy is quite challenged. It's very normal to assume growth will be below trend until something happens and something breaks. That's what the Fed's goal is meant to be. In our baseline scenario, S&P 500 earnings below trend for 3 years, 2021, 2022, 2023. How do you start to move and adapt to what that world looks like? Diversify. Find good ways to get to your goals with a little bit less risk, and that's what yields are offering you.
Well, let's finish there. Top pick. Favorite thing right now in fixed income. What is it?
I think it's just core, boring, unsexy bonds. Munis, core IG. And you're locking in an interest rate of 5.5%, 6%. Look, our community doesn't love unsexy ideas, but you can get 6% and not take too much risk.
Tom Kennedy, good to see you. JP Morgan Global Wealth Management on fixed income. Going back to SVB. Tom, we've been talking about that the last week.
Yeah.
I wasn't here for much of the last month. I mean, so I almost said the last month. I didn't talk about
What
that.
did I miss here?
But did over the last week.
I don't think this is a marginal issue, and what tells me that it's still there is the stock price action. Given the healing of the bank system and the verbiage from institutional authorities, PacWest should not be flatlining like it is. It should have a bid to it. It does not.
There's a distinction between the risk for regional banks versus the risk to the broader economy. And what Tom was saying there, that from a macroeconomic perspective, the regional banking crisis was not an economic crisis and didn't have the bleed-through effect that many thought that it would. And I think that is what we're seeing priced into a lot of the bond market, at least, as well as potentially equities.
John, it's important there because you listen there for the Bramall point.
I always do.
The marginal Bramall point.
It was only a few months ago. You know, really, it was only a few months ago.
When was the last time we were all together? I mean, it's Christmas.
It's been a month. I think it's been a month. It's good to have Bramo back around the table.
Yeah,
if you are just tuning into the program, welcome to the program. The S&P 500 turning positive 0.08%. Coming up at 8:30 Eastern Time, so 18 minutes from now, Steve Risciuto of Mizuho Securities pushing ahead to inflation data later this week. CPI Wednesday, Tom, Thursday, PPI.
It's going to be a great brief, no question about it.
That's your takeaway from Steve.
No, it's going to be a great brief. I mean, the guy's wicked granular. There's no question about it.
I've got 90 seconds on the clock and you give me 3-word answers.
Well, it's like I'm focused on the king and the president. I'm watching the king and the president.
I'm trying to adapt and adjust.
How's it going?
It's painful, like corporate America.
Steve Risciuto, let me explain this. Not only does he have the glory of having Dominic Constant with him to provide a great financial synthesis around it, but he is expert at digging into the dynamics of that algebraic GDP function. He's the best at it. There's no question about it.
Going into next year, as we push that recession call out and start to think about a second half, which maybe will continue to deliver, and we reflect on the calls that came in through the start of the year when we were thinking about dip and then rip. Remember that? And then it was just rip and then rip, maybe rip
some more.
A bit more.
Yeah, your Timur of Fidelity put out a note that I thought was really interesting overnight, where he was talking about how the market always inflicts the maximum pain on the maximum number of people. And the maximum amount of pain would be to flush out all the shorts, to have it rip higher, keep going, recession gets pushed out, and then eventually, when everyone's rightly or wrongly positioned, then it'll hit.
Krishna said last week, high yields, that's your next pain trade. Long end, 10-year. Happening last week at least, not this morning. 10-year, 4.0457%. Steve Risciuto, 16 minutes away.
commodities.
Could face bigger challenges.
Britain's next was going to keep rate World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make a decision.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. July 11th, Bloomberg is live in Lithuania for the NATO Leaders Summit. Support for Ukraine, expanding partnerships, broad security challenges. We're bringing you news from the meetings and what they mean for the markets.
At the summit, we'll actually make important decisions to address our two main threats, Russia's aggressive actions in our efforts to fight terrorism.
It all starts July 11th. Bloomberg, your global business authority.
It's my hope that and belief that there is a path to bring inflation down in the context of a healthy labor market. And the data that I've seen suggests we're on that path.
Janet Yellen, U.S. Treasury Secretary, speaking on CBS over the weekend to set you up for the week ahead with tons of economic data still to come. This from Stuart Kaiser over at Citi. Equity markets are a nominal growth plus risk asset, so continued positive economic data alongside stabilizing inflation is a positive combination for markets. We have had the first part of that, the positive economic data. You need the second part of it, stabilizing inflation numbers. We'll see if we get that on Wednesday and on Thursday, respectively. At the moment, your equity market just about turning positive as we inch towards the opening bell, 1 hour and 13 minutes away. Equity futures here, Tom, up by almost, I say almost, 0.1%.
It's going to be interesting to see, and particularly to see how the equity market rebounds, perhaps, into the angst of, OMG, what's J.P. Morgan going to do Friday? But, John, it's amazing to me that we were 12, 13 VIX, and we've pulled back in this gloom to 15.31. 100 days ago, 15.31 would have been, a religious experience. That's how far we've come.
And Mislav Matejka talked about this over at J.P. Morgan, the low volatility, FOMO full swing, complacency being built into stocks with the VIX at the lows of its recent range.
Yeah, I wonder what global Wall Street, like Tom Kennedy was just with us from J.P. Morgan, what do you do to people who are up 4% blended, up 7% blended going, excuse me, sir, what are we doing? I think there's...
Well, that's not enough after the double-digit gains elsewhere.
I just think that permeates the zeitgeist here of a busy summer. Somebody over the weekend in the Hamptons said there's no Hamptons this year, that Wall Street's just grim about the potential layoffs, the right sizing, whatever you want.
You went to the Hamptons this
No, I did not. I did not go to that.
You're talking about that article in Business Insider?
Maybe. I think maybe it was Chanel Bassic's Threads account. She was on
the Hamptons.
Yeah, on the Hampton zeitgeist as well. Right now, and I want you to lean forward on this, Mary Lovely's hugely qualified out of Syracuse University, senior fellow at the Peterson Institute, to speak of the mysteries of China, including her leadership at the China Economic Review here a number of years ago. Professor Lovely, thank you so much for joining us this morning. I want you to sum the mystery now, the zeitgeist of China, the Pacific Rim, 3 or 4 big cities, and then all of that distance of China to the west out to Chengdu. Is China struggling? Is China flat on its back, or can we be more optimistic?
China is struggling. It is not flat on its back. It clearly is struggling. We're waiting for the Q2 numbers to come out in a week or so, and we'll know how badly it is struggling. But it definitely is struggling. It had a little bit of wind under its sails coming out of the end of zero COVID, but consumers are just not having it. And of course, the global economy has slowed. It has managed to have several good quarters with its net exports, but it's looking for drivers of growth, Tom, and it's not going to find them in the households.
Is the hierarchy, and I'm going to use this phrase as an amateur, the hierarchy of the Communist Party that all that matters is employing people?
No, very much not. It is, of course, preserving the rule of the Chinese Communist Party and preserving the role of the state. And of course, one of the key ways you would do that is to keep people employed. But we've seen some very serious problems with urban unemployment among college-educated youth hitting almost 20%. So they have a really serious problem in terms of driving jobs, not in the factories that were hit with the Trump-era tariffs from the U.S. Instead, this is in the service economy. It's in the higher tech sector. It's in finance. It's in the kinds of jobs that college-educated young people, were trained to do and expect to have.
Given this backdrop, Mary, how does that influence, how does that color the discussions, I should say, that were had with Janet Yellen, Treasury Secretary, over the weekend, the second high-level U.S. Policymaker to head to Beijing in the past month?
That's a great question because, of course, the two intersect. The Chinese would love to see a decrease in tensions with the U.S. They would like to see some rollback in the Trump-era tariffs. Janet Yellen coming is good news. Not only is it's a further visit from someone very high up in the Biden administration, but it's someone they're familiar with. It's someone who has enormous respect globally, an enormous amount of experience in the U.S., both at the Fed, now at the Treasury, and in other ways. And so they treated her, I think, with the dignity and respect that she's due.
Given that there is that respect on one hand, there didn't seem to be a lot of resolution to anything. Do you think that there were any inroads made over the weekend, especially given some of the blowback that Janet Yellen has gotten for kowtowing, maybe even quite literally, to Chinese officials in a way that perhaps people in the U.S. are not as interested in?
Yeah, that's just noise. If you look at it, she's an older woman, tiny woman. She's going up to shake hands. This is noise. She's there to actually do business. And I think that her main message from President Biden was that we are trying to put some guardrails on the relationship. We do have major disagreements with the Chinese, but it's a relationship we want to manage and manage in a way that doesn't lead us into higher and higher levels of conflict.
Mary, your Peterson Institute is led on thinking about an America that post-pandemic will adjust to a higher rate regime. Adam Posen and Olivier Blanchard really leading the charge on this. How does China fit into that? If we bring our general level of interest rate up, what does that do to China?
Well, it's clearly a challenge for China because it leads to a tendency, if they didn't have capital controls, you'd see capital flight as investors would try to get higher yields. So there's capital flight, there's pressure on the currency that they don't want. So that sort of takes their monetary policy and says, we have to do this with it. At the same time, they would like to continue to stimulate the economy. They've tried to do it with what's called targeting credit expansion, and they have a number of different individual pots of money for small businesses, for different sectors, et cetera. But they're still having trouble. That is not really having the effect on the economy that they're hoping.
Mary, thank you. We have to leave it there. Mary Lovely there of the Peterson Institute on the economy in China. We talked about the surprises of 2023 so far just moments ago in the market. This market's ripped. The NASDAQ doing tremendously well after a really difficult year last year. That's the market surprise. The economic surprise, what happened to China doing all the heavy lifting, Lisa? The reopening story, the boom we were expecting there to spread through Europe. And now we've got, what, Germany in recession? And China struggling. We're talking about stimulus in China in the middle of the year, really?
Right, and we're talking about not necessarily just a reopening, but a lack of willingness to invest, a lack of willingness to spend by consumers who can't find jobs, as we were talking about with Mary Lovely. Taking it a step further, how does this play into the commodity space and the importance there? The idea that we didn't see also the boom in energy prices, and perhaps that was a tailwind that offset the fact that China didn't provide the boom.
If you've got an answer for that, OPEC Plus and the Saudis would like to know.
I'm sure that they would.
Because, Tom, I don't think they're too happy that we're still down in the 70s.
Off the pandemic surge, I mean, we went from 2020 in the blended Bloomberg Commodity Index to a boom index. We've pulled back, and technically there's no way we've broken commodities to a higher visibility. No way whatsoever.
Great lineup in the next hour. to get your week started. Amanda Lynham of BlackRock, Brian Levitt of Invesco, Samir Samana of Wells Fargo. Tom, those conversations coming up in about 35 minutes' time.
Be interesting to see. I mean, there's no question about it, what Brian Levitt does here in terms of asset allocation. And to me, I mentioned it earlier, the 60-40 conundrum for me, for a huge body of our listeners and viewers. I mean, this was gospel. You put 60 in here, you put 40 in there, and you played golf, and gone. It's evaporated.
You know the barbell now, Tom.
Yeah.
You put some money in some cash-like securities, you pick up 5%, you put some money in AI, and you do something more interesting than play golf.
I don't, I...
Surf.
Yeah.
Go away for a long weekend.
Get points.
My essence here, John.
Lots of points.
And
they don't need to put up that on a credit card.
We're having an October conversation in July. That's the heart of the matter.
Yeah. You're just skipping summer, aren't you?
Yeah.
No interest in summer. No vacations, TK. Okay.
Kids.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Bloomberg Surveillance, good morning, everyone. Jonathan Farrow, Lisa Brownson, Tom Keene, we're all together again. Farrow's gone off to get ready for a 9 o'clock Cineramic escapade. It'll be wonderful to see what he has at 9 o'clock, given markets churning here. It's a churn before CPI Wednesday. Lisa Bramwitz and Tom Keene with you here, and it's a rich discussion to be the least. And this morning, for those just joining in across America, it's real simple. It's about China, the whispers of deflation and disinflation as well.
To put it all together, there were a lot of weeks so far this summer where not a lot happened and people were just sort of spinning their wheels trying to come up with a new narrative. This week is actually going to be incredibly important with both the CPI report, the last week of Fed speak, and lots of it before the quiet period, the geopolitics of China and the U.S., potentially deflation there, but also what's happening with respect to the tit for tat between the U.S. and China. And then to put the boot on all of this, we've got Friday, we've got bank earnings kicking off. You put that together, that is a massive pivot point for people who are already reassessing and pushing out further recession calls.
To get out to Wednesday, and CPI Wednesday will have complete coverage for you at 8:30 beneath the headline data. We stop Tuesday. It's something that we're not spending enough time on, which is the small business report, the NFIB small business report. What is the mood of people small enough to run their businesses off their charge cards, but frankly, companies that are bigger than that? I don't like the phrase small business, but this is the heart of America, many would say.
6 a.m. Eastern tomorrow, we do get that small business optimism survey. How not optimistic are people who actually have to pay the bills and pay higher salaries and find the workers and everything that we have been seeing when we do go on vacation, or if you don't and you just, play tennis in Central Park like Tom Keene every day with a cigar.
I watch them play tennis. I'm not playing tennis anymore, which is a good thing for the tennis community. Have you watched Wimbledon?
I have.
I have not watched them.
A little bit.
Brief me on it.
Well, I mean, just we will get more from there, but yes, carry on. CPI data, you're talking about that, due out on Wednesday. Stephen Rasciuto of Mizuho Securities pushing out his recession call, among many others as well on Wall Street, to 2024, adding, without a rise in joblessness, the economy remains stuck on the current trajectory, which would eventually lead to rising inflation expectations and higher long-term rates, despite global excess saving. And Tom, to me, this is really the key question. The resilience that we see in businesses, the adapting and the adjusted, and the economy and the labor market, how much higher do rates have to go to really bring inflation down to where the Fed would like it to be?
And it comes to the granularity of Stephen Rasciuto. He's chief U.S. economist at Mizuho Securities, and can be across the core equation, Y = C + I + G plus something to do with net exports. But Rasciuto, of course, in a recent note, goes much bigger and broader. I love how you push back against secular stagnation. That's the gloom that's out there, and you say America's different. Talk about America in the media frenzy on secular stagnation.
The point behind the U.S. economy is the underlying resilience. The Biden administration, as well as the Trump administration, provided an enormous amount of excess savings into the system through the COVID stimulus. And there's still, by our estimates, about $1 trillion there, which contrasts easily with the San Francisco Fed number of $500 billion. But even more important than that, we have healthy balance sheets for the household sector and for the corporate sector, the non-financial corporate sector. Even when we look into the banking industry, despite all the regional bank hiccups we've seen, there's still a solid balance sheet for the industry in general. And I think that drives home the liquidity. So between the liquidity, the excess savings, the health of the balance sheet, this is not a credit crunch recession that we're anticipating. That's why it's hard to call the beginning of it. This is an inflation recession, which means the Fed has to get short rates high enough to choke off levels of economic demand, and they're trying not to do that. And the net result of that is they're slowing the economy but delaying the inevitable. So you run the risk that you could wind up with increased inflationary pressures built into the system. What they need to do is they need to get the belly of the curve up, because that's where securitization takes place. That's where everyone funds. They don't fund in the Fed funds market or in the 30, 60, 90-day market. They fund in the 3 to 7 year maturity gap.
I look, Steve, at the respect that you and I have for someone like Lawrence Summers, his early research on hysteresis with Olivier Blanchard, among many other accolades as well. But there's Lawrence Summers on stagflation. Should we worry about stagflation? It seems to be, is there something like at least a stagflation? Is that a word?
Well,
help me with stagflation.
I think you do have a greater potential for stagflation to unfold from this if policymakers hold on to this experiment that they're trying to run for too long, which is to craft a soft landing. You look at what the markets are doing. The markets are being very rational. The equity market's saying the Fed's forecasting a perfect soft landing. So they've priced in a perfect soft landing. You look at the curve. The curve is saying the Fed's going to keep on raising short-term rates, but then they're going to cut rates real quickly. So the market has this downward slope to it, and we were over 100 basis points inverted between 2s and 10s about a week ago, and now we're about 80 to 90. The difference is almost all of that downward adjustment in the curve is concentrated in the Fed funds, the 2-year to 5-year sector, which means a lot of the impact that you're getting from monetary policies not winding up finding its way through to the cost of financing for households and corporations.
You've said a lot that we have to unpack. The idea that this is not a credit crunch recession, building on what we heard from Tom Kennedy of JP Morgan, that the verdict is in. We have seen that the regional bank crisis was not an economic crisis and didn't have the ramifications for the economy that a lot of people believed. How high do you think the Fed has to raise rates for it to be restrictive in a way that it is not now?
It's a function of the curve, and to the extent that we have to get the 5-year note to current 2-year note levels, that gives you the impact. Now, how high does the Fed funds rate have to be to get there is the question. And that's a difficult question to answer. I do believe that if we had the 5-year note trading where the 2-year note is trading right now, we would have a very, very different level of macroeconomic activity. So that differentiation there then gets into, well, how much of a curve does the Fed anticipate a cut? And that's what's important about the dots in the SEP, because the dots in the SEP, although they did raise the level of rates, okay, they actually made the curve drop steeper over time. So they went from saying 80 basis points worth of adjustment downward to 100 basis points worth of downward adjustment. So they kind of took out the sting of what they were doing.
This all goes to, if you're just trying to parse through bond speak, this idea that the higher you raise rates in the near term, the more quickly you'll induce a recession that brings rates lower over the shorter to medium term, which offsets the actual effects of monetary policy. Correct. Where does the balance sheet play in then? Is that the other tool at a time when you have seen it actually accelerate in terms of its deceleration, of its decline?
Well, I mean, you got to remember, they've put so much into the system with the $5.4 trillion that they monetized, and the economy has grown. So some of that excess is being eaten up by the growing economy and the expansion that's necessary in the underlying balance sheet for the economy. But they've got more room to take out, but I don't think they have the opportunity to accelerate it, to be honest with you. I think there's a good degree of risk implied in trying to do both interest rates and quantitative tightening at the same time. And I think they would have been smarter to have just done one first and then done the other later.
When you talk about pushing out the recession, that seems to be consensus with a lot of people who we talk to. It's kind of obvious if you take a look at the data, which is not consistent with recession very much in most areas of the U.S. What is the nature, the contours of the recession when you expect it to hit next year? Well, it's going to be very shallow, or it should be very shallow. They're not going to try to kill it. And that's part of the process. So it's an evolutionary process of trying to get there. And this gets back to Tom's question about stagflation. If you're not going to kill it and wring out the excesses in the system, you run the risk that inflation expectations get embedded in the system. And if inflation expectations get embedded in the system, then you could get an environment where the economy slows, but you don't necessarily get the full bang for your buck on the disinflationary side that you have. The benefit of the global deflation story, Tom, is it's holding down long-term real yields and nominal long-term rates. That's helping to keep the economy growing as well, because that continues to contribute to the idea that there's still ability to finance out the curve, and it's helping to invert the curve between 2s and 10s.
Let me squeeze this in. I got like 8 ways to go here and 8 questions. This is so interesting. Is the great moderation over? I mean, I just did a log concave chart of what the price of bonds has done according to the Bloomberg Total Return Index, and the slope, that acceleration of the great moderation is ebbed. Can we say it's peak done and we're going to cut down to a new non-great moderation?
That's a darn good question. I think the global deflation story is the key to that. And to the extent that we have expanded our production facilities by diversifying our supply chains in an environment where the global economy is aging, in an environment where the global economy is slowing, you do have cyclical inflation that's taking place in the U.S., Europe, and to some extent in Japan, but you have global deflation taking place outside of it. And it's that trade-off that's being reflected in the inversion of the curve. The long end's being held down by the global constructs. Right. The short end's being pushed up by the domestic cyclical constructs, and that's creating, the Fed's creating the problem by anticipating cuts. If they weren't anticipating cuts, we'd have a different macro
Help me here in July on getting to October. My first question to Georgieva at Marrakesh is simple. Given the IMF's 2028 gloom, which you just voiced with disinflation, how does America adapt and adjust to a global slowdown in global deflation?
It's hard. It's hard.
Agreed.
But we do benefit from the fact that we are the largest net importer. So we wind up suffering from the potential deflationary risk, which gets back to your question. Could we get back to the great moderation? The answer is, if they deal with the cyclical issues correctly, yes, we would get back to the great moderation. If they deal with the cyclical issues incorrectly, we could wind up with stagflation before we then have to deal with those issues and get us back to the great moderation.
Fascinating. Steve Risciuto, thank you so much for a brief here from 60,000 feet on the American economy. Lisa, to me, and I thought about this over the weekend, the basic idea of John Williams reaffirming a low R-star, and I've been taken about how many people I respect agree with the president of the New York Fed that we can be optimistic and get back to some form of that great moderation with a sustained, more subdued R-star.
Ellen Zentner, the soft landing from Morgan Stanley. A lot of people talking about this, that the amount of debt, the demographics, the aging population make it very difficult to see inflation gathering steam, which is a reason why I'm so curious about some of the geopolitical tensions that could raise prices of commodities in a way that we have not seen so far this year. Where do some of these other factors come into play when we start talking about the bigger underlying inflationary
It goes into the oil call very quietly here. Brent nudges up near $80 a barrel. I mean, did you go long while you were gone? Did you go long oil?
No, I went long airline futures and pretzel futures for all of the flights, which I think is interesting.
I don't know how you did it. I heard it was terrible. We will continue. Red and green on the screen right now. The VIX 15.41.
To pick up on that, though, I just want to say yesterday was the busiest day for commercial aviation ever recorded by Flight Tracker, which is this tracking mechanism online, which to me, I mean, again, that's sort of the tenor behind some of our discussion about inflation. Prices are higher. Experience, it's worse. Pro tip. And yet people want to travel and get out there and they're willing to do it.
You look at the celebration of Greek recovery and, of course, the Prime Minister, who's been a great supporter of the efforts of Bloomberg surveillance, winning a resounding re-election. I guess everyone's celebrating. I saw an image of the Acropolis this weekend. I wouldn't want to be there. It's so touristy and crowded. You know, I just, why would anybody go over and wait in line for 6 hours when you bought a ticket 3 months ago?
The Vatican, the Acropolis. I mean, if you go to Rome, I mean, if you go to any of these, it's incredibly crowded from all accounts.
It really shows what Pharaoh did, where he went to 4 different islands and no one was there. It's incredible.
Yeah, well, I mean, but this to me goes to this sphere of if you don't have inflation globally, it could potentially simmer down. But since you have it so strongly in Europe, since you have it so strongly in the U.S., since you have it so strongly in so many places around the world, it gets harder to see how we get down to something that's more reasonable without some sort of more material intervention.
I'm in the camp that there's other factors out there like technology and maybe some American exceptionalism as well. I have to admit Europe is, to me, the biggest mystery right now, not the least because they have a war going. Later today, our Maria Tadeo in conversation on that Europe with the president of Lithuania. And again, Amory Horton scheduled, I believe, to be in Lithuania as well. The president is in London with the king. Stay with us worldwide on Bloomberg News. Good morning.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
July 11th, Bloomberg is live in Lithuania for the NATO Leaders Summit. Support for Ukraine, expanding partnerships, broad security challenges. We're bringing you news from the meetings and what they mean for the markets.
At the summit, we'll actually make important decisions to address our two main threats: Russia's aggressive actions in our efforts to fight terrorism.
It all starts July 11th. Bloomberg, your global business authority. Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
There's an issue here of tight labor markets. There's an issue here of psychology having shifted. And I think the interaction of those things in the absence of a slide into recession or something like that is just going to blunt some of these unwinds that are happening here. And we shouldn't ignore that as well. We were running inflation at the core 5% this year. I think we're going to slide below 4, but I don't think we're going to slide on a sustained basis below 3.
Our treasured team there, giving you the voices on a Monday morning you need to reset for the week. Bruce Kasman is chief economist, head of global economic research at J.P. Morgan. I really want to state that, on Friday, first of all, we don't plan for anything here at Surveillance, but the basic idea is somebody went to me or Lisa, you were in a Racket River somewhere, or Pharaoh, who was having a gelato, I think. They called up Pharaoh and they said, "What do you want to do?" And he says, "I want to reset for inflation on Wednesday." And that's really what we're doing today.
I just want to say,
resetting for inflation.
You could go on vacation too, rather than just sort of lobbing these jabs in there about other people.
Time zones. I got 14 time zones. I'm covered now. I'm home with vet bill and kennel fee. Getting it done.
I will say, though, I take your point about CPI and how important that's going to be. It's the last major data point before the quiet period and then the Fed. Although, and we were talking about this earlier, I think you brought this up, Tom, where we kind of believe July is a lock. It's going to be a hike. What about after that?
No, we're going to have to see. Red and green on the screen right now. Two-year yield 4.95 down from that 5.05. Shock here. We've heard a lot on interest rates today. Joining us right now, what's really good about this is her kids are at camp 2020 hindsight. Gina Martin-Adams joins us, chief equity strategist at Bloomberg Intelligence. 2020 hindsight, October of last year. What did Bloomberg Intelligence say about the equity market?
Well, our models did give us an indication that at the very least we were in a massive sentiment washout for the index, which historically are pretty good conditions to start taking on a bit of risk. At that point in time, our fair value model also suggested that the market was positioned for a 15% downdraft in earnings growth coming for the next 12 months. So really big earnings recession was priced into equities. And luckily enough, that earnings recession has not happened. We've seen earnings remain weak, but actually excluding the energy sector get a little bit stronger or at least less weak. And that's what's taken the market by surprise so far this year.
I went back in my youth and I looked, it was a week where I bought 2 Bob Seger albums. These are record albums, Gina. You're too young for this.
Got it.
Big record albums.
Noted.
And the hardest thing off the bottom in that pessimism is the second leg of a bull market. I identify it as January of 1976. Is this the second leg of a bull market? What are the attributes that will allow you to identify?
Yeah, we need to see leadership broaden beyond the top 5 in the index or even beyond the top 7 in the index to establish that second leg. We did see that occur in June. We saw a pretty significant broadening of the advance indeed. But I think there's still a great deal of nervousness as to whether anything other than the top 5 can produce some earnings growth into the second half of this year, which makes this earnings season pretty consequential. because the top 5 is absolutely leading earnings growth. That segment of the index is expected to post 17% growth in EPS year over year. That's a big earnings gain relative to the market's decline.
Are modeling 17%?
The biggest stocks in the index.
But that really, just to build on what you're talking about, highlights the concern that some people have, which is that the largest companies are masking what's going on elsewhere. Does it make it difficult to talk about an index level when it's so heavily skewed and doesn't reflect some sort of mean?
It does, because when you focus only on an index level, you miss everything that's happening underneath. And this goes beyond the top 5 as well. Remember last year, everyone thought, oh, earnings are holding up much better than expected. But if you decompose the index and you looked at earnings ex energy, you saw a very clear earnings recession emerge in the S&P 500. We're having the opposite occur today. So I think it's extremely important to decompose the index into its constituent parts, look beyond even the sector level, look at aggregates in a very different way, because otherwise you're not going to get the investability right.
Which is why people are increasingly looking at equal weight indexes. And I've seen a number of reports, particularly over the weekend, highlighting that you're seeing actually a real comeback there as well, because people are looking for other places to put their cash and the FOMO that JP Morgan talks about. How can you judge whether that's gone too far if you just take a look at the bird's eye view?
Yeah, it's challenging, but I do think you want to look at things like valuations for the equal weighted index, which are still well below their pre-pandemic average levels. There's plenty of room for that valuation sort of level to re-rate outside of the big cap tech stocks and outside of the largest stocks in the index. I do think you want to look at earnings growth, excluding the top 5, which even when you exclude the top 5 and you look at earnings growth ex energy, you are starting to see some stabilization emerge. We need to see that continue. We need to see a bit of follow through into the second half of this year. We need to see the macro conditions continue to support that stabilization. And critically, this has been an earnings recession that's really all about inflation and not about growth. And I think that's left a lot of people on their back foot, because we've been in an environment where growth was the only thing that really mattered. And now we're in an environment where inflation is predominant. And so it took a lot of people by surprise when the earnings stream turned out to be a little bit better than anticipated. And most of that is because of the inflation dynamic, which shifted materially earlier this year. We need to see that continue. CPI has to grow at a pace faster than PPI. Both need to continue to decelerate to really support this margin stabilization, which should lead to a broadening in performance and earnings at large.
I just brought up a small store out of Bentonville, Arkansas, and I'm looking at a PE on Walmart of 24, 26, something up there, which I think is just absolutely insane if it's growing at single-digit level. But I'm looking off the BQ screen. Folks, the BQ screen is where Gina Martin Adams goes every day on the Bloomberg terminal to become wiser. Price to cash flow of 11 times cash flow.
Yeah.
That's a lot smaller number. What does that signal to you?
Yeah, I think that this is really important, very important, because cash flow was under an extreme amount of distress in 2022 as well. And this is another thing that was completely missed in the sort of the consensus speak was earnings are better than expected, but cash flow fell throughout 2022 year over year. Cash flow is starting to improve. We saw our first quarter of improvement in the first quarter of this year. We should see cash flow continue to improve through the rest of this year. And importantly, investors are not paying for that cash flow. And I do think that that provides an opportunity for companies that can produce that bottom line cash flow growth for some multiple expansion. Now, is it for the overall index at large? Not necessarily, because you're still paying an enormous amount for some pretty grim cash flow dynamics for the broad index. But on a stock-by-stock basis, an industry-by-industry basis, there are tremendous opportunities.
And Lisa, to give you an idea, I got the HP12C out, folks, because if the day gig doesn't work out, I'm going to go work for Gina Martin Adams at Bloomberg Intelligence. Apple's free cash flow from pre-pandemic to a model of where we are now, it's only up 79%.
I know, it's been a tremendous rally. I take what you say, Gina, about the importance of both CPI and PPI, and CPI needing to rise at a faster price than PPI. On Thursday, this is another way of saying that they can keep jacking up prices more than their base costs. That's another way of basically saying the same thing. Dovetail that into Friday and the bank earnings and what importance you place on them at a time when people are looking to some sort of lending contraction.
Yeah, so bank earnings is a whole another story for what's going on in the S&P 500, because this is, like energy, one of the weaker components of the index where people are actually losing a lot of faith bank earnings expectations for growth have roughly been cut in half, a little bit more than half over just the last 6 weeks, as investors are continuing to get very nervous about that. And this is about loan quality, it's about credit quality, it's about sort of deteriorating credit conditions. It is about growth more so than inflation, with the one exception of the inflation's dynamic on the inflation impact on the yield curve. So financials are sort of in this worst place sort of position because they've got negative yield curve spread. An inverted yield curve is terrible for bank earnings as a signal. They are not particularly expensive, but nonetheless, no one has any faith in the earnings outlook because of the risks that are still sort of underneath the surface of this economy, and that is credit quality is a real concern. Everybody's very worried about the degree to which credit quality can maintain some stability going into the second half of the year. Financials are therefore ground zero for this risk. And I don't think that's necessarily going to change in second quarter. We've seen no indication of change at all. So we probably will start off the quarterly earnings season with some relatively weak results and then have to ramp up into the stronger components of the index as the season goes on.
Gina Martin Adams, thank you so much. I got to go move on to a surveillance correction.
Okay.
Just to see if I can come back tomorrow. Kimon from Athens listening. He's with one of the major Athens banks. Thank you for all of you in central banking in Greece and commercial banking who listen every day to surveillance. He says, Tom, you're an idiot. And he says, I was comparing the Acropolis to Disney World, equating them. And I apologize if that was the tone that I took. I was not equating the Acropolis of 525 BC as compared to Pinocchio of 1949 AD. I didn't want to be disparaging to Mr. Mitsotakis.
Your apology has been recognized. Duly noted.
Can I come back tomorrow?
You can come back tomorrow.
Thank
Slide
you.
Rudolph.
Sigh of relief. Good morning.
Oh, yeah.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights.
How has that shaped your strategy for the bank?
Is this a new normal? Is this like a catalyst?
Do you think we're in a new phase for dividend policy overall?
That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
In the middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are, launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yangwang yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Let's get your week started. Live from New York City this morning. Good morning, good morning. Equity futures just about unchanged on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, coming up, earnings season just around the corner. Chairman Powell on track to hike once again, and President Biden touching down in Europe. We begin with the big issue, inflation data, up next.
We get CPI.
The June CPI report.
Watch CPI. Let's see what the data is telling us.
It's going to be a softer number.
Quite soft.
Squeezing the last little bit of water out of this inflation sponge is probably going to be more difficult than a lot of people expect.
You have risks that inflation actually increases.
Some reason to believe that inflation will be too sticky.
Core is going to be critical.
Core inflation has been very sticky.
Depending on what we see from the inflation data next week, we could see another rate increase.
It's going to be pretty hard to stop the Fed from hiking.
So they're worried about inflation.
They really feel that they got to get this inflation down.
It's arguably going to require a recession.
Substantial amount of damage.
They're going to keep at it.
There's still a long way to go in terms of bringing inflation back down to the Fed's target.
Joining us now to discuss BlackRock's Amanda Lynham, Invesco's Brian Levitt. Amanda, first to you and to both of you, thanks for being with us. Amanda, I guess my first question, are we still on course for a hike this July?
Good morning, Jonathan. Thanks for having me. It's great to be with you. We think we are. And as you know, and as we've talked about it, I think over the past few months, for us, we've acknowledged that we're probably closer to the end of this hiking cycle, obviously, given the significant cumulative hikes that have already been achieved. So whether we get one or two more hikes throughout the course of the year remains to be seen. Probably the path of least resistance is for a few more hikes. But I think the more important consideration for corporate credit investors is how long we stay in this tight monetary policy regime. We think that we'll stay here for a while, and that certainly has implications for both credit risk premia, but more importantly, defaults and downgrade risk. But I think that's probably the metric to watch for corporate credit investors is not necessarily how many more hikes we get over the next few meetings, but rather how long we stay in this kind of restrictive policy environment.
We need to get through the first two meetings first. July looks like the debate is almost over. Inflation data just around the corner. Before we get there, then it's on to September. What happens in September? Andrew Hollenhorst, the Citi, says let's go. He says a rate hike at the end of this month is highly likely. It's priced in by markets. We continue to expect another 25 in September. This is from Morgan Stanley. They say no. They say we continue to expect a move in July. The incoming data will not meet the bar for the Fed to deliver a hike in September. The labor market remains strong, but there is continued evidence of slowing that we expect to persist. Brian Levitt, first one to you. September, which camp are you in at the moment?
I don't think they're going to raise rates in September. I mean, obviously, things can change between now and then, but you're going to have the headline number down in the low threes. Now, I know that core remains sticky, but a lot of that is shelter. And if you look out at what's happened to home prices or rentals, substantial amount over a very, very short period of time. I mean, can't we just wait and see what the lagged effects of all of this is going to be? We've never had an environment where inflation has come down the way it has and then skyrocketed. I mean, we know directionally where it's going. The break-evens are very low. Inflation expectations are generally contained. I think this is the last one. You know, obviously they're data dependent, but I would like for this tightening to be over.
Your words. Classic end of cycle type stuff. Amanda, do you see classic end of cycle type stuff in credit right now?
Not in terms of valuations, but we do see it when we look under the surface. I think the two things that I would highlight are the divergence in default trends against those pockets of the corporate credit market that are very interest rate sensitive, so leverage loans. We're also keeping a close eye on commercial real estate. And then the fixed rate counterparts where the defaults have been relatively more contained. Actually, if you look at that spread of the trailing 12-month default rate between the leverage loan universe and the high yield bond universe. Leveraged loans are outpacing high yield bonds in terms of defaults by the most since 1996. That's when the Moody's data began. So you are seeing that manifest in terms of stress in that interest rate sensitive pocket of the economy. But as you know, we don't view the high yield market as immune. In fact, if you were to look at the universe of high yield borrowers and you look at the difference between the current coupon that they're paying and where they would need to refinance if and when they choose to come to market, for a large part of the economy, that spread is either 300 basis points or 400 basis points or even more. And so when we do think about late cycle risks and kind of headwinds to corporate credit quality, those are the things we're keeping an eye on. I would say that despite the outflows from the market, despite all of the talk about downside risks to growth, valuations really aren't reflecting that. High yield spreads are below 400 basis points, as you both well know. And so I think it does warrant treading carefully. The other kind of one thing I would point out is that there is this tug of war against this late cycle backdrop, as I think Brian correctly called it, in returns and for all of the talk about loans being interest rate sensitive and defaults really outpacing high yield bonds, loans have outperformed on a total return basis thanks to their floating rate nature, obviously. So there is a constant tug of war that we need to monitor between the fundamental headwinds and what we can actually achieve in terms of returns. And I think being nimble and responding quickly is going to be the key for the second half of the year.
Amanda, let's tease that out a little bit more. That spread that you identify, what people pay, companies pay on their debt right now, those coupon payments, and what they'd have to pay if they reissued debt right now, only matters when they have to reissue debt. And that breathes some life into the conversation, the debate we were having a little bit earlier, how long the Fed is going to stay at these levels. That will have implications when companies come back to market. So with that in mind, where's the maturity wall? How far out into the distance is it, Amanda?
Yep. So the maturity wall becomes significant for high yield bond issuers in 2025, and it really doesn't let up until 2028. So it's a really heavy maturity wall. I would say two things. One is 2025 sounds very far off in the distance, but as we know, high yield corporates typically don't let their bonds become current. So they don't let them become maturing within the next 12 months. So it's realistic to think that in 2024, corporates will start to address those upcoming maturity walls in earnest, if not before, again, given some of the downside risks to growth, and we know that the primary markets can be choppy. The other thing I will mention is that there's a subset of capital structures, and a lot of those line up with the sectors like in telco, media, cable, in pharma, in retail, where there is a big disconnect between the current coupon, thanks to proactive refinancing in 2020 and 2021, and the current yield where they would refinance. Some of those capital structures just might not be economic in a higher for longer cost of capital environment. So leaving the nuances of the near-term maturity walls aside, does the capital structure make sense in a period of higher cost of capital and slowing growth, below trend growth? And so that's something to keep in mind. And I think the key takeaway for investors is that while we do not expect defaults to revisit even the peaks of COVID, we do think that there will be more dispersion under the surface, and we do expect a modest uptick in defaults throughout the next several months.
Brian, that's the big question, isn't it? Higher for how much longer?
I mean, at some point, this Federal Reserve is going to have to normalize the yield curve. And the way you normalize the yield curve is not typically with a jump in long rates. You know, this recent move up to 4 is obviously on better than expected economic data. But again, we still haven't seen the lagged effects of all the policy tightenings. I would expect the 10-year to start to move back down to where it was and settle in there, which means you're going to be in a deeply inverted yield curve environment. I don't know how long that can persist. I would expect that, you know, as the economy slows, which, by the way, I think the equity market did a good job of pricing last year, as the economy slows, and the Federal Reserve is going to obviously back off the tightening stance, but at some point is going to have to start working to re-normalize the yield curve. And that's typically how this plays out. I don't suspect this to be any different. So the question is, what does it all mean for investors? Again, the market went down 25% last year, which is very much in line with more mild recessions of the past, like an 81, like a 91. Markets are up, what, 17% since inflation peaked in June? That's pretty standard. That's the way these things play out. And typically markets do very well after the end of tightening. And so I would, there's some challenges ahead with a slowdown in growth, but if you've got a 1-2 year horizon, I think markets are going to do well, as they typically do in the aftermath of Fed tightening.
I've got a time horizon of about 20 minutes. We're 20 minutes away from the open and bow. Tons of economic data this week, tons of Fed speak too. CPI just around the corner. Let's get to Mike McKee. Morning, Mike.
Good morning, John. Well, it is a big week for President Biden. He's in Europe, but keeping an eye on what's happening with inflation here. The CPI report out Wednesday is the big deal of the week. We also get PPI, which has been running lower on Thursday, and jobless claims. And then Friday, we get the import price index and Michigan sentiment. So things back off a little bit as the week goes on. But it's also a big week for Fed speak. We're going to be watching the CPI, and we want to know what the Fed thinks about it, because here's where they are. At the moment, the headline CPI has fallen below the Fed's target, but core has not, and it's core they want to see go down. So how far will it fall? Bloomberg Economics thinks we go to 5, which puts it about even with where the Fed's numbers are right now. But if the Fed goes up, that will put more downward pressure, they hope, on core inflation. We will get some immediate reaction because we get a lot of Fed speak this week. We especially get some information today that will be a little bit different in terms of the impact. Michael Barr, the head of supervision for the Fed, is going to be laying out some of the new bank regulations that they're going to be talking about. But Daly, Mr. Bostic, and then on Wednesday, a whole host of them talking about their reactions to the economic data that we've had. Thursday is very interesting. 1 year ago today, John, here at the Rocky Mountain Economic Summit, Christopher Waller laid out a view of the economy that said we can have a soft landing without higher inflation. And you remember that triggered a paper from Olivier Blanchard and Larry Summers saying that Waller was wrong. And Waller responded to that, and we got a little economic food fight going. A year later, we have inflation coming down, and so far, no problem with the unemployment rate. So let's see if Chris Waller takes a victory lap this week.
I'm going to make a note of this for next year, the Rocky Mountain Economic Summit. Mike McKee in a log cabin with a burning fire, talking about economic data. Where did the rest of us go wrong? Mike, thank you, sir. Brian Levitt, Mike went through the data in the week ahead. Bank earnings on Friday too. JP Morgan, Citi, Wells Fargo. What are you expecting to see in those numbers?
Yeah, we're starting to see a moderation, some challenges for the larger banks. I mean, nothing that would take you back to, past crisis of yore, but you would expect that in a slowing environment, investment banking challenge. You're seeing some bank write-offs now, which have picked up. So I think the critical point is to say that there's, anytime you see tightening like this, anytime you have a slowdown, the banks come under some challenge. The good news is, and investors could probably breathe a little bit easy, is that these banks are well positioned, well capitalized. They're not sitting on mountains of bad debt, but these are parts of the market that tend to not do as well in the later part of the cycle.
Amanda, what happened to the credit crunch?
I agree with a lot what Brian said in terms of pulling back in activity and lending. I think as it relates to the March disruption, certainly the outcome of that was much more benign than I think many market participants, including ourselves, anticipated. That's a good thing. I don't think, however, that it means that it's over. If we read what the companies are saying, both in last quarter's earnings and just in some of the data, we were already seeing a tightening of lending standards heading into March. We expect that to continue. Banks are talking about higher cost of deposits. Some banks are talking about prioritizing existing customers in terms of lending relationships. And so I do think for a subset of the economy that's looking for funding, the banking channel may not be the place where they can have as much success going forward. We think that opens up a pocket for areas of the market, say for private debt, for example. That certainly also extends to the private real estate market if we think about the longer-term headwinds facing the commercial real estate market. So I think in a nutshell, it means that there's probably a slow burn happening in terms of a pullback in credit availability. But the good news is that we didn't have the adverse scenario that maybe we would have thought that we were facing when we were in the thick of it in March of this year.
Massive change in just a few months. Amanda, Brian, this conversation's going to continue. Amanda Lynham there. and Brian Levitt. Let's get you some movers going into the opening bout, 16 minutes away. Here's Abby.
John, with the futures down ever so slightly, let's take a look at one of the big tech names that is dragging. Microsoft heading to a second down day in a row, falling more than 1% on Friday, down about 0.8%. This, of course, going into earnings season, worries of valuation and that perhaps the bar is high. Rivian Automotive, on the other hand, up 2.6%, heading to a potential 9th up day in a row. If it closes higher, it will be the longest record winning streak ever. And of course, all of this having to do with the fact that they did confirm about 2 weeks ago 50,000 vehicles to be made this year. And Amazon has now made $1.8 billion on their stake. And then finally, Charles Schwab up 1.4%. We have two brokerage houses having positive comments and providing price targets of $73. JMP Securities in particular has upgraded Charles Schwab to a market outperform, and again, a $73 price target ahead of their earnings report this week.
Interesting. Abby, thank you. And ahead of the bank earnings later this week on Friday, JP Morgan, Citi, Wells Fargo, on to the rest of them through the next week or so. For those of you not familiar with the arc of earnings season, the banks go early, then you get to the tech names. We'll get to the tech names later on this month. Coming up next on this program, President Biden touching down in Europe.
Holding NATO together is really critical. I don't think there is unanimity in NATO about whether or not to bring Ukraine into the NATO family now, at this moment, in the middle of a war.
That conversation up next.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
We're in a situation where Ukraine continues to be brutally attacked across the board by munitions. It took me a while to be convinced to do it. But the main thing is they either have the weapons to stop the Russians now keep them from stopping the Ukrainian offensive through these areas, or they don't. And I think they need them.
President Biden meeting with UK Prime Minister Rishi Sunak ahead of the NATO summit, discussing financial and military aid to Ukraine, including Biden's controversial plan to send cluster munitions. Most NATO members objecting to that decision as Biden makes his way to Lithuania. Let's get to Katie Lyons now, first of all, for more down in Washington, D.C. Katie, I want to talk about that specific point becoming increasingly controversial.
Yeah, that decision on Friday to provide these cluster bombs is, of course, the U.S.'s response to the fact that Ukraine is running out of ammunition, but it was not without pushback, even from those within the U.S., many Democrats expressing concern over that decision. The concern, of course, being the potential for civilian casualties and collateral damage as a result of that. Now, Ukraine's ambassador to the U.S. was actually on one of the Sunday shows over the weekend, promising that Ukraine will use this responsibly, but it still remains a concern. Of course, this will be a broader issue at NATO, the supplying ongoing of ammunition and weapons for Ukraine. But the other issue that will be a subject of the alliance when it meets for this summit is whether or not Ukraine ultimately should join NATO. We were just hearing President Biden there expressing concern because, of course, the articles of the alliance dictate that an attack against one is an attack against all. And given Ukraine is actively engaged in a war that risks drawing all the other members into this conflict, which is why it's a tough ask, but still Ukrainian President Volodymyr Zelensky is going to make the trip to Lithuania to try to make the case that they should be allowed into this group after the war. Another question about whether or not NATO should expand is Sweden's inclusion in this alliance, accession to the alliance. Of course, that is something that is currently being held up by Turkey. They have concerns about Swedish essentially the opinions there of Muslims. And we do understand that President Biden, on his way to the UK yesterday, did speak by phone to Turkish President Erdogan, discuss the prospect of purchase of F-16s as well from the U.S. to Turkey. We'll see if that is enough to kind of grease the wheels here to actually get Turkey to drop its opposition to Sweden joining this alliance, John.
We can head to the UK right now, Katie, and catch up with Guy Johnson. Guy, Katie went through 3 points there. The first point, cluster munitions. The second, NATO membership for Ukraine, and then Sweden as well. Did those issues come up this morning, Guy?
They were all discussed. Clearly, the issue of munitions, I think, is front and center. The UK has pushed back a little bit on that. I think there is an understanding of why the US is making the decision that it is making. It is not a decision that the UK is going to be making in terms of the provision of those weapons. The issue of Sweden, the issue of what happens with Turkey are difficult decisions, I think, that NATO needs to think about. Turkey bought the S-400 weapon system, which put it at odds with the supplying of US weapons. The Russian-made S-400 weapon system, the air defense system, is something that the US doesn't want in the same arsenal as its own weaponry. And I think the linking of this obviously is very interesting from a Turkish point of view. The Turks are also pointing at the fact that they would like to maybe see their EU membership progressing as a result of maybe a decision on Sweden. So there are lots of convoluted points around all of this. John, I think the bigger point here from the UK's point of view is making sure that the UK and the United States are aligned in terms of their thinking going into this meeting. The UK and the US collaborate on a whole range of other issues, including what happens in Asia, including the Five Eyes system of security and intelligence. There's lots of things going on here. It is significant that Biden came here first to make sure the ducks are basically in line before they progress to the NATO meeting.
And then on to a meeting with King Charles after meeting with Rishi Sunak. Guy Johnson, looking forward to your coverage, sir, in about 38 minutes' time, alongside Alex Steele on Bloomberg TV. Katie, thank you. We'll catch up with you, no doubt, a little bit later. King Charles III meeting with the President of the United States, and I'm told also with philanthropists and investors participating in a climate engagement a little bit later on. Something to look out for, perhaps. Coming up on this programme, the morning calls, and later, Samir Samana of Wells Fargo sounding the alarm on earnings just ahead of bank earnings on Friday, with Wells Fargo, Citi, JP Morgan just around the corner. Going into those numbers and going into CPI on Wednesday and PPI data on Thursday. Equity futures going absolutely nowhere. 3-day losing streak on the S&P 500. Will it become 4? We're pretty flat right now. From New York, your opening bell about 7 minutes away.
don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Away from the cash open, equity futures just slightly negative. 3-day losing streak on both the S&P 500 and on the Nasdaq 100 too. Let's see if we make that day 4. That's the price action. Here's some morning calls. First up, Wells Fargo downgrading Fox to underweight, seeing elevated risk to the company's news viewership ahead of results. That stock is down by 1.6%. Your second call coming from the team over at Morgan Stanley, raising their Netflix price target up to $4.50 and growing increasingly bullish on its streaming business as it continues to gain market share. That stock is just a little softer, slightly negative by 0.08%. And your third and final call comes from the team at Evercore, downgrading Citizens Financial to inline, $29 price target, expecting accelerated loan declines and funding pressures to threaten quarterly results. We're down there by a little more than 2%. Coming up on this program, Wall Street sharply divided as ever over the outlook for equities after one of the best first halves on record. We'll catch up with Samir Samana of Wells Fargo coming up next. Your opening bell just around the corner.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The trading week officially begins in about 20 seconds' time. Going into it, equity futures slightly negative, softer down by, let's call it 0.1% on the S&P. No real drama here whatsoever this Monday morning. On the Nasdaq 100, down about 0.1% as well. Losses through the back end of last week. Some losses this morning. We recover slightly going into the opening bell. There's the opening bell. Switch on the board and get to the bond market. Yields are looking at a little something like this on a 10-year, down a basis point to 4.05%. On a US 10-year. The trend over the last few weeks, so the front end, yields up, up, up and away. 5 consecutive weeks of yields climbing at the front end of the curve. This morning, yields declining by 3 basis points on a 2-year to 491, on a 10-year to just a little north of 4%. The FX market, the euro, slightly weaker against the dollar, 109.60. We're negative there by not even 0.1%, and crude down by 0.7%, $73, and let's call it 30 cents. Let's call it 30 seconds into the session. Your equity market shaping up as follows, down by not even 0.1% on the S&P, and a little bit softer on the Nasdaq. One stock to watch at the open, Meta. The new social media app Threads topping 100 million users in less than 5 days. Evercore's Mark Mahaney saying this: we estimate that Threads can generate approximately $8 billion in annual revenue by 2025, generating almost $1.50 in incremental EPS, or 6 to 7% accretion to Meta's 2025 earnings per share. Abby has more. Hey, Abby.
Hey, John. And you can see that Meta is popping higher, up 2.3% now on the year, up more than 145%. This, as Threads does have over the last 5 to 6 days, 100 million subscribers, as you just talked about, putting it on pace to be the most downloaded app at a record pace, really even taking out ChatGPT. Apparently, ChatGPT, 100 million subscribers over 3 months. And as you just mentioned, Mark Mahaney over at Evercore is very bullish on this over the next 2 years, putting a number on it, $8 billion, and the idea that they could gain 200 million subscribers. Now, its competition, Twitter, of course, has more than 200 million subscribers already, but the threat of this is it could be a big piece of why Twitter last week did, of course, send a letter to Mark Zuckerberg basically telling them to cease and desist. Now, if they were to pursue litigation, it would be potentially over trade secrets. That's a pretty vague area of the law. The hurdle would be high for them to prove. They'd have to go under the hood and prove that there was something happening there, that employees at Instagram and at Threads right now, Facebook, I should mention, Instagram saying that there are no Twitter employees on Threads, but they would have to make every effort to prove that that did not exist. But the other hurdle could be, has Twitter done everything that they potentially can to make sure that any secrets was really put in place, that there was some kind of Chinese wall put in place? Lots ahead, but right now we do clearly have Meta benefiting from this, up 2.5%, John.
That's just today. Abby, thank you. Today up 2.5%. Year to date up by 147%. Close to 150% higher year to date. That, by the way, the number 2 most performing stock on the S&P 500 year to date. You want the top 5. Number 1, Nvidia, up by about 193%. Number 2 is Meta. Number 3 is Carnival Cruises, up by 138%. Tesla, so far this year, up 125%. Royal Caribbean, up there as well. What is it about cruises? Up by more than 100% year to date. Those stocks are absolutely ripping in 2023. Let's turn to the auto sector. Rivian looking to extend its rally to a record 9th consecutive session. Better than expected production and delivery numbers fueling the stock's 80% advance since late June. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. The stock really bouncing around, swinging between gains and losses in the early part of this Monday session. We're softer by around 0.4% on Rivian. We were higher by as much as 3% following the open. It's kind of finding its feet and settling. If the stock closes higher, it will be a 9th consecutive session of gains, a record for Rivian. The stock has gained more than 84% in the last 8 sessions through Friday. But reminder, this is a stock that fell 82% in 2022. It was the second worst performer on the NASDAQ 100 and was actually removed from the NASDAQ 100 in May. The catalysts were a week ago production and delivery numbers for the quarter that beat analyst expectations. They also started to give some sense of progress on the electric delivery vans that they make for Amazon, their biggest investor. They've started rolling out a few hundred units to Europe in German cities. And in an interview with me last week, the CEO, RJ Scaringe, outlined that the reason they were able to do that is they built out the supporting infrastructure in Europe. We're now higher 0.4% and bouncing around, but it's a stock that's had a lot of attention of late, and it's kind of moving away from the large pack of other EV startups that have struggled to be real, get real volumes on production. And you'll see, actually, John, that in terms of analyst price targets, we are seeing the analysts start to catch up. I think the average 12-month price target right now on Rivian's $22.86. We're trading at $24.80 a share. The post-IPO peak in November 2021, $172.01 a share. We have a long way to go to get anywhere near that.
Just to build on those points, you know this management well. Is this real competition anytime soon for Tesla?
Yeah, look, the guidance for this year is 50,000 units across their two consumer products and the van that they make for Amazon. During the interview, RJ Scaringe said that around 20% of that volume will be the Amazon van. But on paper, the factory is capable of so much more. And I asked him, why don't you just raise guidance? You know, based on the numbers, based on what the installed capacity is. And the response was, our aim is to exceed targets. And that has been a frustration for the street. They think that Rivian should be producing in far greater volumes. The question is, a pickup truck and an expensive SUV just a sort of niche corner of the market? And Rivian is staking its future on a mass market model called the R2 that won't go into production until 2026. That gives you a sense of how far away they are from being a bona fide mass market competitor.
Ed, let's just finish on the competition for Elon Musk elsewhere.
Sure.
Threads. How's Twitter responding to that?
Yeah, I mean, Elon Musk has taken to Twitter over the weekend. He's made a number of comments on Twitter, most of them directed at Mark Zuckerberg, seeming to be humorous. We don't hear anything from Linda Yaccarino, the CEO, and there's been no sort of proposal on platform innovation to change anything about the platform that would ward off the competition from Meta. I think that's where the question is. What does Twitter do in response to make the platform better and therefore competitive and against the threat of what Threads is providing?
Interesting. Ed, looking forward to the coverage with you and Caroline Hyde a little bit later on today. Bloomberg Technology on Bloomberg TV in about 2 hours and 30 minutes time. For the broader market, about 6 or 7 minutes into the session, equities positive by 0.1% on the S&P, dead flat on the NASDAQ. Here's another mover for you. Icahn Enterprises surging at the opening bell. Carl Icahn and several banks finalizing amended loan agreements that unite Icahn's personal loans from the trading price of his company stock. I should say unties those two things. Katie Greifeld has more. Hey, Katie.
Hey, John, this according to reporting from the Wall Street Journal, some needed breathing room for Carl Icahn just 2 months after Hindenburg Research, of course, disclosed that short selling report against his investment firm. Now, for context, Carl Icahn has borrowed billions of dollars against his share in Icahn Enterprises. And given that the stock has dropped about 40% or so since that short selling report came out, that had thoughts of a margin call on investors' minds. So we are seeing some relief there. You can see shares up nearly 12% at this moment. And just to get some more details, in addition to untying his personal loans from the share price, these amended agreements would also increase Carl Icahn's collateral and also set up a plan to fully repay the borrowings in 3 years, again, according to the Wall Street Journal. So shares currently up 11.5% at the moment. If this move holds, John, it would be the biggest rally in about 2 months.
Not bad. Katie, thanks for that. The latest on Icahn Enterprises, that stock doing nicely. We've just had the best first half on record, leaving strategists very split over where stocks are heading in the second half. There's a 50% difference now between Wall Street's most bullish and bearish year-end targets, marking the biggest mid-year gap in 2 decades. Joining us now to discuss, Samir Samana of Wells Fargo. Samir, wonderful to get your perspective on things. Which camp are you in? Which side of that split are you on?
Yeah, I guess we're on the more cautious side. And I think a lot of it has to do with, look, we appreciate the strength in the economy, and I think it'd be fair to say things are slowing probably a lot more slowly than people are expected. I think the tricky part is the Fed's reaction function remains pretty much intact, which is they want inflation close to 2%. And there's almost only one way to get it there, which is to raise rates further than markets expect and leave them there longer than markets expect, which just means that the multiple that you're willing to pay for equities is going to be a lot lower than people anticipate.
So the problem we've got is that pockets of this economy are doing badly, pockets of this economy are doing well, manufacturing's in recession, services is okay. If you look at the prices in the respective industry groups, goods prices softer, we know that story has been developing for a while, services prices pretty sticky. Do you think a binary debate about a headline recession or not is the right approach to all of this?
No, actually, we would say, look, focus kind of on the bigger picture with respect to, are things slowing or are they getting better? And we would argue that although there's been some recent improvement, they will get worse into the back half of the year. What to us is more important in the, in terms of kind of the investing debate is what credit's going to do in the second half of this year. And we really do believe when you look at high yield spreads, when you look at investment grade spreads, you're not getting paid to take the risk there. And as those spreads start to blow out in the latter half of the year, that's what's going to be driving investment and asset pricing. It's not even going to be so much the economy. I think the tricky part is going to be that although you have credit spreads widening out, the economy at that point will probably also be hitting the skids. And I think the tricky part is all of those things will happen at the same time in kind of the second half.
Amanda Lynham of BlackRock talked about credit spreads a little bit earlier. High yield, as we know at the moment, is trading pretty tight, so tight it's south of 400 basis points the last time I looked. Samir, when you use language like spreads are going to blow out, what kind of numbers are you thinking about?
So at least in previous, kind of recessions, you've seen numbers, kind of in the high, single digits, maybe even, just reaching double digits. We were just there not that long ago in, the fall of last year. I think we got close to 650. So in a true recession, it wouldn't surprise us if you're looking at 700 plus on spreads.
Where does that leave equities?
It leaves them lower, which is why our target continues to be 4,000 to 4,200. We've only made one revision this year. It was actually to the downside, again, having to do with the economy, which we do think will slow in the second half. And then, like I said, at one point we thought that maybe the Fed could get away with, kind of interest rates in this area, but now it seems like they may have to go a little bit further. So if you've already got earnings being pressured, and then the multiple, is also going to be pressured much more than we anticipated. Again, if I were to make a revision, I think it would probably be again to the downside. It's really difficult to see how things are going to play out better than markets anticipate from these levels.
The divide is amazing right now. If I take Max Kettner of HSBC and read his research this morning, it's almost the polar opposite of what you're telling me, Samir. He said this morning, that contrary to expectations, the first half proved to be a good half for risk assets, and we see little reason to change our risk on stance. He went on to say for the second half, we see risks around macro data running too hot, far from recessionary expectations. Samir, what would you say to the Max Kettners of this world?
I think the part that they're missing is if the data does continue to run too hot, you're probably talking about a Fed funds rate probably north of 6%. That is not going to be good for risk assets. I think the tricky part is the Fed is tightening, which is a leading indicator, right? That's slowly seeping into the economy as people kind of reset on their rates. I think the tricky part is the economy is a little bit of a lagging indicator in the sense that, again, those Fed funds hikes work with kind of those long and variable lags. So I think the tricky part for a lot of these folks is the too hot economy is kind of the lagging indicator. And if the Fed goes too far, by the time the economy slows, you're already going to have rates at too high levels, and the Fed's not going to be able to reverse course quickly enough.
Samir, let's say you're right. What do you like right now?
So we would continue to focus on larger cap equities. Until recently, we were favorable on tech. We took that off because, again, multiples probably are a little bit ahead of themselves. We like healthcare, we like energy, and we like materials. Energy and materials, it might take a little bit longer to play out, especially if there's a recession and China continues to slow, but we do think you get paid to take the risk there. We would continue to avoid consumer discretionary and real estate. Those are the parts of the economy that will probably be hit hardest by any slowdown. Within fixed income, we would also continue to play some defense. So we like the short end of the curve and the long end of the curve because we think you can lock in some of those yields. And then we would continue to avoid credit until you get to a place where those spreads are compensating you for the risk that you're taking.
Could you give me the geographic split as well? I read this from Citi this morning. They've cut their call on the US. They said this, our US strategy team thinks mega cap growth is set for a pullback. They said US recession risk could still bite. Sounds like you might be on the same page on that last point. They said we raise Europe back to overweight. Europe is once again trading at a record discount, should benefit from a weaker dollar and any stimulus out of China. Samir, where are you on the geographic split right now?
So we're US 1, we're developed markets 2, and we're emerging markets 3. We did recently upgrade developed markets from most unfavorable to neutral. So, you know, if there is a little bit of resumption of kind of economic recovery in Europe or in China, we think that's the best way to play it, not emerging markets proper.
Do you think the data overnight from China opens the door to some stimulus?
I mean, the door's been open for stimulus for a long time. I think the tricky part is the currency keeps weakening, and the fact that the Fed has to go further, you know, has got them a lot, you know, worried about capital flight. So I think that's the tricky part, is they're just kind of pinned in. It's one more thing that, you know, I guess the implications of inflation running too hot in the U.S., those are kind of the global implications with respect to the Chinese can't really stimulate until the Fed's kind of done with their tightening cycle.
Oh, Samir, let's leave it there then. So you expecting China to hold off from any big-scale stimulus anytime soon?
Big scale, yes. Targeted, I think they'll keep doing some things around the edges.
Samir, thank you, sir. Appreciate the clarity on that. Samir Samana there of Wells Fargo Investment Institute on global markets and what he's expecting from China a little bit later this year, and on the Federal Reserve too. If you are just tuning in, welcome to the program. About 15 minutes into the session, equities positive by 0.1% on the S&P, slightly negative on the NASDAQ. Coming up later this week, we have CPI on Wednesday, PPI on Thursday, and then we close out a week with earnings. Up next on this program, investors looking ahead to big bank results.
Bank earnings are going to continue to show a challenged outlook. You have, from the deposit side, banks are needing to pay up to shore up their deposits. And on the lending side, you are seeing lending growth slow.
JP Morgan, Wells Fargo, Citigroup kicking off earnings season on Friday. We'll get you a preview with Shnali Basak up next.
Covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. From the world of politics,
we're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that
it.
Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that
get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Bank earnings are going to continue to show a challenged outlook. You have, from the deposit side, banks are needing to pay up to shore up their deposits. And on the lending side, you are seeing lending growth slow. In our baseline scenario, S&P 500 earnings below trend for 3 years, 2021, 2022, 2023.
Investors gearing up for a crucial earnings season following the best first half on record. Wall Street forecasting a 9% drop in Q2 profits, the biggest year-over-year decline since 2020. Morgan Stanley's Mike Wilson writing, quote, with earnings beginning this week, better than feared results likely isn't going to cut it anymore. The team at Goldman taking a different view on things, writing, we expect companies will be able to meet the low bar set by consensus. Negative EPS revisions for 2023 and 2024 appear to have bottomed, and revision sentiment has improved. All this as the attention turns to the big banks, with JP Morgan, Wells Fargo and Citi due to report results on Friday. Joining us now with a preview, who else? Shanali Basak. Hey, Shanali.
Good morning, John. When you take a look at the biggest banks, the things that were making big money in the last couple of quarters, you're seeing that start to subside. That is the trading desk, which had brought in a lot of money in 2020, 2021. Listen, now you're looking at Goldman Sachs saying that it could drop by about 25%. JP Morgan saying about 15%. Bank of America is holding up better than many with about a flat expectation here. But some of the investment banking businesses here are now spilling over into troubles in trading. Now, when you take a look at the lending side, also, there's a question here about whether net interest income needs to be revised. Loan demand across the industry has been quite sluggish. So remember, these lending books across all the different banks look very differently. We have had Wells Fargo recently downgraded over at Wolfe Research because of that commercial real estate footprint, because of that mortgage footprint. So it's going to be choppy across all the big six banks. The question is, are there revisions into the second half of the year that will read through into what the banking picture looks like into next year? And that has nothing to say for the regional banks. That could show more choppiness, given that we've had deposit flight that has only continued throughout the quarter.
Well, let's get the update on that, Shanali. 3 months ago, there was a very different approach to this sector. This was it. It was all about the banks reporting, not just the big ones, but the regional ones more specifically. What's the approach to earnings season this time around?
Listen, the bigger banks, particularly with the trading desks, have held up so much better than those big consumer banks. But now that you see this quarter, those troubles starting to eke into those numbers, and remember, even among the trading desks, they all have very different footprints. Goldman, for example, heavy in commodities. That's a very different story in commodities this year than it was last year. And so if you're not making the money in those kind of big money trading businesses here, where are you making money? I think is the question going into the second half of the year into next year.
Shanali, thank you. Looking forward to it. Shanali's coverage ramping up on Friday. We'll touch base with Shanali ahead of that, no doubt, on Friday to go through it again. Goldman, Wells Fargo, Citi, then on to all of the rest through next week. Let's get you some sector price action. Let's get to Abby.
Hey, John, and the sector action today is super interesting. We have the S&P 500 up fractionally, but more sectors than not are higher. In fact, industrials up by 1%, healthcare up by about 0.8%. That's the same deal for staples. Financials up 0.5% to 0.6%. So lots of strength there. But on bottom, you have those heavyweight tech sectors. Those are the three sectors that are down. That is the big weighting to the index. Let's just call it 25 to 30%. So you have the index basically flat and unweighted. There is one area of technology that is flying higher today, though, and that is the chip sector. That stock's up about 0.8% on the year, up an amazing 42%, heading to its best year since 2020. And this, of course, has to do with Taiwan semi-manufacturing, a good number. They beat estimates, John, in their quarter, having a lot to do, of course, with that AI demand boost that's helping out a lot of the chip makers.
Abby, thank you. Nasdaq slightly softer this morning. S&P 500 is just a touch firmer, positive by, let's call it 0.1% on the S&P 500. Your trading diary up next.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Four days of losses on the Nasdaq 100. Haven't seen that many times this year, given the rip-roaring rally we've seen on that index so far year to date in 2023. So far this year on the S&P 500, double-digit gains this morning, positive by not even 0.1%. That's the equity picture. I just want to finish on the bond market story just quickly. 2s, 10s, 30s. Yields just a little bit lower this morning at the front end by 3 basis points. Let's call it 491 on a 10-year, just about holding on to 4%. Yields lower there by a single basis point. That's the price action. Let's get to the trading diary. Coming up, Fed Vice Chair for Supervision, Michael Barr, speaks in about 10 minutes' time. Plus, we'll hear from Daily Mester Bostic throughout the rest of today. The 74th NATO summit kicking off tomorrow. CPI coming up on Wednesday, followed by initial jobless claims and PPI on Thursday. And then we get the big banks reporting on Friday. JP Morgan, Wells Fargo and Citi just around the corner. From New York City, that does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day and the trading week for that matter. This was the countdown to the open. This is Bloomberg.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
The top names in business are on Bloomberg.
For Indigo, this is a 500 planes order. That's the biggest order ever in terms of number of planes. It doesn't change the short-term perspective on ramping up the production.
All our aircraft deliveries are delayed. The supply chain that was really decimated
during COVID.
It's a real challenge for all the OEMs at the moment, but we absolutely have to have those aircraft delivered on time.
Nobody covers business like Bloomberg, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Kind of got a mixed tape out there in the first half hour of trading. Coming up, we're going to get the latest on China. Lots of economic news there. Treasury Secretary Yellen visiting China as well, so get a breakdown of what is going on in China. Plus, we're going to check in with Liz McCormick. She's one of our go-to people on all things Federal Reserve. She's going to be in studio, so we're going to check in with her. Plus, Kate Duchesne, CEO of RGP, give us the latest wrap on this labor market. Is it as strong as we saw from some of those numbers last week? We'll have all that coming up in the first hour. But first, let's kick things off. Let's check in with Nathan Hager and get a Bloomberg Business Flash.
Well, you said it, Paul. Stocks are mixed at the start of the week. That's going to be characterized by a slew of economic data. We get inflation readings, a lot of Fed speak, and, of course, the kickoff of earnings season at the end of the week. I want to pass along this red headline that just crossed the Bloomberg terminal. Fed Vice Chair for Supervision Michael Barr is laying out plans for bank capital, saying big banks will face higher capital requirements. So I'm sure we're going to be watching bank stocks as we get more details on that. But more pain could be on the way for stocks as a whole as profit warnings and fear of higher interest rates weigh on the S&P 500. That is according to our latest MLive Pulse survey. Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets, says investors have been nervous about earnings all year long.
Most years, earnings expectations are way too high to start the year. They're way too high the prior year. They tend to come down. It doesn't destroy the stock market. But if you look at where estimates are in years that forecasts are too high and come down, typically by the time you get to the middle part of the year, the consensus expectation is in the right neighborhood. You don't really see too much change in the overall S&P earnings picture in the back half of the year.
We check the markets all day long for you here on Bloomberg. Right now, the S&P 500 is higher by 9 points. That's a gain of 0.2%. 4408 is the S&P level. The Dow Jones Industrial Average up 200 points, or 0.6%, 33,934. The NASDAQ is lower, down 27 points, down 0.2%, 13,633 for the NASDAQ. The 10-year Treasury is up 8/32, yield 4.02%. The 2-year yield is at 4.89%. NYMEX crude is down 0.2%, or 16 cents, $73.70 for a barrel of West Texas Intermediate. COMEX gold is down 0.25%, down $5, 1927.60 an ounce. The euro, 1.0970 against the dollar. British pound, 1.2787. The yen is at 141.71. Watching Meta Platforms shares, they are moving a little bit higher now, up about 0.2%. CEO Mark Zuckerberg just confirmed on a Threads post that his Threads app has signed 100 million users since it launched 5 days ago. Analysts at Evercore ISI say the Twitter competitor could hit close to 200 million daily active users and about $8 billion in annual revenue over the next 2 years. That's a Bloomberg Business Flash. Bloomberg Markets is on this morning. Paul Sweeney and Madison Mills.
All right, Nathan Hager, thank you so much. We appreciate that. Madison Mills and Paul Sweeney here in the Bloomberg Interactive Broker Studio. We're also streaming, Madison, as you know, on YouTube. So all you need to do is go to YouTube, search Bloomberg Global News, and that's where you'll find us. So go check us out on YouTube. So, Madison, looking at this market here, I mean, I see a Dow moving higher, but just NASDAQ a little bit weaker. So not a lot of movement there on a Monday, but we'll see how there's a lot of economic data coming up.
A lot of data this week with that CPI report. We've also got PPI, so big week. Plus, it's the last data dump that we're going to be able to get Fed speak on before the next meeting.
Yep.
So potentially some market moves on that as well.
Absolutely. And I'm just looking at the CPI print, the headline, the consensus is 3.1. Yeah. You think about where we were a year ago, a little over 9%. It's just extraordinary. And, in my mind, I'm like, all right, that's just wait and see what happens. But I think the Fed's going to be hiking again, is what the pros tell us.
Yeah, it seems like that's the consensus.
All right, got a little bit of red and green on the screen here. Let's see where the action is under the hood, if you will, on this market. Bloomberg's cross asset reporter Emily Grafeo joins us here in our Bloomberg Interactive Broker Studio. Emily, what are you looking at this morning?
I'm looking at shares of Kava. That stock is
up.
up.
I'd love to talk about Kava.
10% now. They're a recently IPO'd company, but today was the day when all of the bank analysts could come out and actually rate this stock, and the majority of them are giving it a buy. Most of them, though, just around $50. That's the average. Right now, we're at 43
and change,
and change for Kava. But it's interesting. I actually thought I came up with the term Mediterranean Chipotle because that's how I think of Kava.
Is that right? Okay.
As a Kava customer.
You did, Emily.
Well, Piper Sandler also had their rating. They said that many have dubbed Kava the Mediterranean Chipotle. Sets a high bar, but they see this as a testament to Kava's strength and the management team. They have an overweight price target of 45. Most of them are, again, a buy. Citi is neutral.
Yep, saw that.
But they said they see Kava as a rare category creator in the restaurant space, similar to Chipotle and Starbucks. I mean, these are two pretty big retail names there.
Category creator, that makes me think back to a restaurant IPO back in the day. Boston Chicken, which is now Boston Market.
Oh, yeah.
And that was a category creator. And I remember the salesperson, I can't remember which firm I was at, came out with the pitch, and I heard the pitch, and man, it was compelling. And that stock ripped, and then it crashed. That restaurant business is tough.
It's tough. We're up about 99% from the IPO, but it's been a pretty volatile month for Kava. There's big up days, but there's also big down days. Right. Today, at least, it's positive.
It's a big valuation stretch, is what I've heard from a lot of analysts. Mike Halen at Bloomberg Intelligence says, boy, even at the IPO price, it was relatively richly valued to some of the peers. So you have to create a new category and give it a new multiple if you're going to put a buy rating on it today, and that's apparently what some of these.
And we are getting close to a lot of those buy ratings, so we'll see how the rest of the week goes. But I love Kava.
I've never been there.
Really
so
good.
Is it in this city?
Oh, Paul.
Yeah. Really?
Well, now we've got an activity for you and I to bond over.
A little field trip. It's in the city?
It's in the city. There's one near Grand Central. Not as many locations as Chipotle or Starbucks, but there's quite a few, and I think it's very good.
I'll get on that. What else we got here?
So I'm also looking at Amazon. Not as much of a positive day for these shares, down now about 2.4%. There was an interesting column on the Bloomberg, the Tech Watch column from this morning, talking about how this week is Prime, well, it's Prime Week, but we have Prime Day starting tomorrow and Wednesday for Amazon. In the last 4 years, though, the stock has fallen for the week that was held during Prime Day.
Yeah.
In the 4 years before that, so 2015 to 2018, we saw an average gain of at least 2% for Amazon's stock. So the author goes on to argue that this now is suggesting Amazon shareholders and investors are more focused on AWS and Amazon's cloud business and not getting too excited anymore about the original business model of retail.
I just put up I used the Amazon, put the ticker in, and then used Matt Miller's favorite function, which is COMP, to compare it versus other stocks, and here against the S&P 500. And on a 5-year basis, it's really trailing the market. That shocked me. It's up about 7.7% compounded annual return versus the S&P of 11.5%. I never would have guessed over the last 5 years Amazon lagged anything, much less the S&P 500, but there it is.
Right. People talk about its strength all the time, a bellwether stock, a mega cap. We'll see what happens this week. AWS is now the company's main source of operating income. So the retail business still accounts for most of Amazon's sales, but AWS, that cloud computing business, is responsible for more of the operating profit.
Well, it's interesting because later this week, we sort of officially kick off earnings season when we start to hear from some of the banks. Talk to me about what we can expect this earnings season. If we do get better than feared results, are we going to see a huge rally, or is that sort of already priced in?
We will see, Madison, because for the last several earnings, all of this year and even at the end of last year, everyone said this is going to be the earnings season where everything finally cracks.
Everything changes.
These high valuations are finally going to feel the pressure of the Fed's tightening and higher rates, and so we're not going to see a big equity market reaction, even if the beats are good. So that's the same message that I'm hearing this morning. We have Morgan Stanley's Mike Wilson, Paul, one of your favorites.
Yeah. Can we quote someone else?
Drilling down this message, but also Binky Chadha from Deutsche Bank also talking about how even if we get better than expected earnings, there's just not a lot of steam left to go in the equity market. So we might not get as much of a rally. But again, this is the message that we've been hearing for months, and we keep getting an equity market rally. So we'll see.
Yep, interesting stuff. Wall Street Journal reporting that the New York Times, to close its sports desk and rely on The Athletic for daily coverage. So that is a sad day, in my opinion, having been a fan of New York Times. But in my opinion, they closed down their local sports coverage a decade ago. And then Joe Nocera, who used to work there and lots of other places, including Bloomberg, and was a sports columnist at New York Times. He told me that about 7 or 8 years ago. The New York Times had kind of punted on local coverage, local news, local sports, and kind of becoming a national and an international paper. So that seems to be continuing right there. Yeah. All right, Emily Gofredo, thank you so much for getting us up to date on those markets. Let's talk about China here. Secretary Yellen there, 4-day visit. Let's get the latest reporting. We've got a couple smart voices here. Eddie Vanderwall, Deputy Managing Editor of the Markets Live team with Bloomberg News, and Chris Condon, U.S. Treasury Reporter with Bloomberg News. Hey, Chris, I know you joined Secretary Yellen on the trip to China. What's the takeaway from ground zero there that you have?
Well, I apologize. Quick correction there. Our colleague Victoria Dendrino was actually on the trip.
Oh, okay.
I'm about to travel with her on her next trip. But,
very good.
But I've obviously been keeping close tabs on this trip. It was, I have to say, first and foremost, there were low expectations in terms of what they call deliverables from this trip.
Right.
The main goal was to kind of stabilize the relationship and how the two countries deal with each other on economic issues and reestablish regular lines of communication. You know, if you go back before the Trump administration, U.S. and China kept a sort of pace of regular phone and in-person meetings with high-level Chinese staffers on economic issues, and that really fell apart due, first of all, to the more confrontational tone of the Trump administration, and then second, just because of COVID. And it's taken a long time to reestablish regular ties. And Yellen has been personally really eager to get those reconnected. And I think on that front, it was a pretty successful trip. From what I understand, she and her staff were very pleased with the way meetings went. They were a bit more informal as time went on. They weren't as scripted as they thought they might be. So that was a good thing. And she does expect from here, her staff will have that kind of regular pace of contacts reestablished where high-level people can get on the phone with each other and discuss concerns or just hit regular agenda items and discuss them. And that's a pretty healthy set of steps.
All right, well, Eddie, I want to bring you in. And Eddie, re-mentioning you are our Deputy Managing Editor of the Markets Live team. You have all of the best quotes that I steal throughout the day to say on air to sound smart. So thank you for that, Eddie. But I want to talk to you about some of this soft economic data that we got out of China, looking like that stimulus urgency is just increasing for the mainland there, Eddie. What is that sort of doing in terms of the impact on U.S. markets this week?
Yeah, look, these were really, really soft numbers that we saw from China. You know, globally, it's quite surprising to see, with inflation around the world running so much above expectations and so much higher than most central bankers would like to see it. In China, they had zero inflation, literally nothing over the last year. The number came in at 0% flat. Core inflation slowed to 0.4%, and producer prices were in retreat. Now, yes, I mean, a lot of central bankers will probably look at that with envy, but it shows just how difficult the situation in China is, and just how much, there is maybe a need to kickstart the economy. Because remember, they only recently came out of lockdown, and it was when the rest of the world came out of lockdown that we had that really strong demand that fired inflation across the globe. But we're just not seeing that, and that's feeding through the market. It's certainly adding a little bit of a headwind to risk assets more broadly.
Hey, Chris, how important is it? I mean, I guess, covering the Treasury there, Secretary Yellen being in China is certainly important. Talk to us about how it kind of works under the, when you get down into the makings of the sausage. Is there that much interaction between members of the staff of the Treasury and counterparts in China? Is this something that really needs to be nurtured?
Well, it certainly does need to be nurtured. It's something, as I said, that deteriorated over the last few years and is expected to restart now. And this can have a couple of different benefits. First of all, Eddie was just talking about what we know about the Chinese economy. Well, the information coming out of China is not always believable or reliable, and those types of contacts help the Treasury, at least, gather more information, gives them a better read about what Chinese officials think is going on in their own economy. In fact, from these meetings, one thing that was taken away is that Chinese officials are concerned about growth and certain pockets of bubbles in their economy, but not overly so. They feel they have it under control. So that's the kind of insight or understanding that Treasury is always looking for more of. And second of all, it's beneficial in the sense that it might help prevent certain contentious issues from escalating in a sort of retaliatory cycle. It gives each side a chance to kind of communicate, intervene, talk things over, and prevent perhaps a more severe escalation of issues that begin as small economic concerns and could escalate.
Well, Janet Yellen kind of echoed the idea that it could escalate, saying that she wouldn't rule out the threat of a U.S. recession, and it's appropriate and normal for growth to moderate as inflation remains too high. So, Eddie, given that, that kind of seems a little bit hawkish, and we're heading into this next Fed meeting here, likely to see another hike, to what extent is that move from the U.S. potentially going to impact China?
Yeah, look, there's definitely divergence of monetary policy around the globe, right? When we came out of COVID, everybody was in the same situation. Growth was very strong and we had fast inflation. And now we're starting to see real divergence. The U.S. is kind of in the middle of the road. It's inflation starting to come down, but it's not where it would like to see it. In China, the numbers are much lower now. I think there's a disconnect here because in the U.S. we're starting to see wages and the services sector driving that, whereas in China it's very much the manufacturing sector that is at fault. And I think as long as China's, as long as its services sector stays strong, then I think they will be shy of providing further stimulus. But I think there is definitely a feed-through between the two economies for sure.
All right, Eddie, thank you so much for joining us. Eddie Vanderwalt, Deputy Managing Editor of the Markets Live team, joining us from London. And Chris Condon, U.S. Treasury reporter with Bloomberg News, also joining us here, kind of giving us a nice little roundtable there, getting a kind of a recap, if you will, Madison, of the trip from Secretary Yellen. Again, establishing contacts. We saw that from Secretary Blinken before. So hopefully this might be good for both sides. We'll have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, it's that time of year again with earnings season kicking off this week. Bloomberg's Charlie Pellet reports. Friday, we hear from J.P. Morgan Chase, Wells Fargo, and Citigroup. The earnings reports come amid a backdrop of inflation and the specter of rising interest rates. Liz Ann Saunders is Chief Investment Strategist at Charles Schwab.
We know first quarter was better than expected. A lot of people are focusing on the fact that calendar year 2023 estimates are lifting, but that's only because of the beat in the first quarter. Second quarter, third quarter, fourth quarter, and even into first quarter next year have all had downtrends in their estimates. So that will come in clearer focus when we start to enter reporting season.
Thursday, it's Delta Airlines and PepsiCo with a focus on pricing power.
Thanks, Charlie. The parent company of Silicon Valley Bank is suing the Federal Insurance Deposit Corporation to recoup nearly $2 billion seized by the regulator after the lender collapsed in March. According to the Financial Times, SVB Financial in its lawsuit claims the FDIC violated bankruptcy laws by keeping the cash. The company also argues access to that money is critical for reorganizing. Silicon Valley Bank's implosion was the biggest U.S. bank failure since the 2008 financial crisis. And shares of Icahn Enterprises climbed as much as 16% this morning. That's after Carl Icahn confirmed amendments to previous loan pacts with lenders. Earlier, the Wall Street Journal reported the agreements untie his personal loans from the trading price of his company's shares. And those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg. Bloomberg Markets returns right after this.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It is 10:21 on Wall Street. I'm Nathan Hager. Major banks are facing one of their biggest regulatory overhauls since the financial crisis in the light of the recent regional turmoil. Federal Reserve Vice Chair for Supervision Michael Barr says he wants banks to start using a standardized approach for estimating credit, trading, and operational risks rather than their own estimates. He also says the Fed's stress tests need a rejigger to better reflect the risks that banks face. Right now, the KBW Bank Index is higher by 0.6%, and financials are one of the 6 main industry groups in the S&P 500, helping the index to post a bit of a gain this morning. We check the markets all day long for you on Bloomberg, and right now the S&P is higher by 11 points, or 0.3%, trading at 4,410. The Dow is up 195 points, or 0.6% at 33,931. And the NASDAQ is just posting a little bit of a gain here, up 19 points, or 0.1%, 13,680 for the NASDAQ. The 10-year Treasury is up 9/30 seconds, yield 4.02%. The 2-year yield is at 4.89. NYMEX crude is down 0.3%, down 24 cents at $73.62 a barrel. COMEX gold is down about 0.25%, or $4.70 at $19.2780 an ounce. The euro 1.0976 against the dollar, the yen 141.63, and Bitcoin's higher by almost 0.4%, trading around 30,300. The New York Times is confirming it's shutting down its sports desk, now relying on the Athletic website, which it bought a little bit more than a year ago for sports coverage. The move affects more than 35 journalists and editors on the Times sports desk. The New York Times stock is higher by 1 1/3%. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Madison Mills.
All right, Nathan Hager, thank you so much. We appreciate it. You know, I followed the New York Times Company as an analyst for 30 some odd years.
Yeah.
They're one of the very few newspapers globally that have really created a viable and growing digital presence.
Yeah.
So, but
it's like the overwhelming portion of their revenue now.
Yeah. It's been a great story. They've done a great job. The Washington Post, the Federal, the FT, and the Journal as well. Looking at the stock, it's up 24% year to date, up 38% over the trailing 12 months. So good for them. But it is sad to see them kind of back away even more, and now completely from their sports coverage. Grew up with that. Yeah. All the great reporters and columnists there from the Times over the years. All right, nobody covers the Fed, I think, any better or any more intensely than Bloomberg News. But one thing that's fallen through the cracks just for me as a reader is like, what's going on with quantitative tightening, that QT thing? Is it still a thing? I don't know. But I know somebody who does know this stuff. It's Liz McCormick. She's a chief correspondent, macro markets with Bloomberg News. She actually follows this stuff. I don't know why, but she joins us actually here in studio. Liz, talk to us about quantitative tightening. Is the Fed still doing it? How are they doing it? Is it important? What's it mean for the economy? And tell us how they kind of screwed up maybe a couple years ago.
Yeah, I'm going to tell you all that. But fun fact, Liz Capo McCormick's brother used to work at Bloomberg Sports years ago. We'll talk about that later.
Sports. Whoa.
Yeah. But yeah, QT is still, we kind of got off the limelight with that, but it's still going on. In fact, in full force, it's going to be about $1 trillion a year that'll come off the Fed's balance sheet. And it was so interesting. I mean, maybe I'm just a nerd, but listening to Chairman Powell speak on Capitol Hill recently, and he, politicians really don't like all the debt on the Fed's balance sheet. I think they feel like it takes too much, sway in the market. And they were kind of saying to him, hey, you're going to get the balance sheet down. And Chairman Powell, like you're alluding to, Paul, said, we are, but we are going to be careful. In 2019, we didn't see it coming that there was scarcity in the banking system for reserves, which created problems. So the Fed had to quickly reverse course, remember the repo blow up, and add reserves. So they're doing their job. They want to get the balance sheet down, but they're being very careful to not make reserves too scarce in the system. So it's not so easy, right? So I think Powell, I give him credit, was saying like, hey, we learned from the last time, we're trying to avoid it. But yeah, it's going on in the background. It's the second tool of their tightening.
So in terms of that being the second tool of their tightening, do you think that the Fed is secretly a little bit excited when bad eco news comes out and they have an excuse to raise rates again because it helps them with their balance sheet if rates are higher?
Yeah, that's funny, right? They would never say that, right?
Yeah.
But they would like, on everything to when you kind of go one way, you want to go back the other way so you have some ammo for the next crisis, right?
Yeah.
So it's tough if you start, every new crisis with an even bigger balance sheet, even though you've done some quantitative tightening, bringing it down. So I think the Fed would really love, like Janet Yellen, I think, was famous for saying, we want QT to run in the background like paint drying, which doesn't always work. But I really do think they're in a new regime. Well, they'll never have the uber small balance sheet that we all saw years and decades ago. But yeah, they would like to get it down a little, Maddie, right? Yeah. So God willing, we don't, but if we go in another crisis, they have the ammo with the ability to cut rates and then jack up the balance sheet again. So it's a little bit of a tricky wicket, I call it, for them.
Yeah.
How does a central bank actually do quantitative tightening? How does it work?
Yeah, so, the central bank, it's easy when we know they're buying. QE,
right.
They just go in there and buy, right? But the quantitative tightening, let's talk about the Treasury side. So what happens is they have Treasury debt that matures. Say they have debt maturing middle of this month. What they'll do is say, hey, we're going to let that mature. Normally, if they're leaving their balance sheet stable, then they buy the same amount that matures. And now they're saying, hey, we're going to let X billion trillion mature and not buy more. So that kind of whittles down how much treasuries they have on their balance sheet. The mortgages are a little more convoluted because depends on refi rates and things like that, but that's what they do, kind of not keep rolling into new debt.
And what does the impact of that look like in terms of overall liquidity?
Yeah, so it's interesting because QE, the buying, was really and is used to kind of help lower long rates. It's felt to help juice the housing market and things. So QT, in a sense, should go the other way. It's a little less clear, but what it does on the short end, like we're talking about in this story, is what it does is, kind of the way all the mechanics work on the Fed's balance sheet is if they let the asset side roll down, then a liability has to roll down. So that's either in bank reserves or this facility they have, reverse repos, where money market funds can put money with the Fed. So that's where, Manny, if we get too tight, then that liquidity is sucking out of the short end, and that's kind of what churns, the financial system, right? Banks having enough liquidity to do their operations. So that's where, on the exit side of QT, that you have to worry about liquidity in the repo market and things like that.
So, Liz, how about, let's just assume I'm on the Fed, and at the end of this month, I argue to my fellow folks on the Fed, hey, we raised rates 500 basis points. Inflation's coming down. We just saw a 3% headline print. We're done. Let's just sit on the sidelines. Why do we have to do anything? It's actually working. Why don't we just do that? What would happen if I made that pitch?
Well, on the rate side, I think that's what they're going to eventually get to. Let's just say they hike in July. I can't remember if that was in your scenario.
Well, no, my scenario was don't do anything. We're done.
Well, right. Yeah. So say they don't, which is possible, right? Now, that's the one tool of their policy, the rates. So in that scenario, what the Fed has been saying is, like, QT is going to keep going, right? Where it gets tricky is the Fed has always said, I'm sorry, I'm Italian, I talk with my hands. We don't like our tools to be moving in opposite directions. So say, which we're far away from that, the Fed started lowering its benchmark rate. Then if QT is going on, it's like one hand of the Fed is easing and the other is tightening. And most people say the Fed won't want to do that. Like the folks at TD who see easing later this year say the Fed's going to stop the QT because it doesn't make sense to be going in opposite directions. But there's a lot of variables, so we don't know. So it's going to be interesting to see what happens in July. I'm already thinking about August and Jackson Hole. What guidance does Chairman Powell give us?
Should I go to Jackson Hole?
Yeah, let's go.
Of course you should go, Paul.
All right, I'll put a ticket in for that. See how that works.
What are you anticipating then in terms of Fed moves? It feels like July is a definite. Do you have a take on September?
Yeah, I think that's the wild card now. We're already kind of like looking through into September. And there's a mix. There's a lot of economists on Wall Street who say one more July and we're done. Then there's others saying, hey, the Fed has more to go. We're not seeing policy really be that restricted because look at the stock market, look at the housing market. Right. So some are saying, terminal rate has to be even higher, maybe over 60%. So I think I was talking to, the folks around my desk today, and we were saying it sounds boring, but it's going to be data dependent. Like it's like you were saying, the data, if we start getting another strong jobs, if CPI misses to the upside, we have a lot of data between now and September. The Fed kind of has to do, if inflation is not coming down, they're going to have to do it. So I feel like, oh my God, will we ever get a break? It's not going to be calm, right?
Yeah.
So again, it seems like we were just getting some data passed around the newsroom here, talking about used car prices coming down. I mean, there's so many data points that you can look at here, but does the Fed feel like in order from a credibility perspective, they need to hike one more time? Is that kind of where we are?
Well, the analysis on Wall Street goes that the Fed doesn't like to surprise the market. And when the market, like the futures and the short-term overnight interest rate swaps are pricing in like a near certainty that they hike in July. Fed doesn't like to surprise. So I don't know if it's credibility, but I don't think they want to upend the market. We're so close to that meeting, right? I mean, I could be wrong, but I suspect that they kind of have it priced in already. It's almost like a done deal. Look, let's just do it, right?
Yep, and if you look at the warp function, which Liz is referring to, it's almost a 90% expectation that rates will be hiked in July. So to the extent you don't want to upset the apple cart, there we go. All right, Liz McCormick, thanks so much for joining us here in our Bloomberg Interactive Broker Studio. Always good to see you in the office here. Liz McCormick, Chief Correspondent covering the global macro markets for Bloomberg News again. So we'll have some economic data this week, some inflation data this week, CPI, so it'll be really interesting, PPI as well. Get a good read on inflation, which the Fed will certainly need prior to meeting at the end of this month. I guess we'll get an announcement on July the 26th. Right now, let's head down to Washington, D.C., world and national news with Amy Morse.
All right, thank you, Paul. President Biden, as you know, is in London, a stopover on his way to the NATO meeting in Lithuania. UK Prime Minister Rishi Sunak spoke of increased economic cooperation.
Great for us to carry on our conversations, which we were having just a month or so ago, it feels like, in the White House, where we signed the Atlantic Declaration, first of its kind economic partnership.
Later, President Biden met with King Charles III at Windsor Castle. That was their first meeting since the king was crowned. As NATO leaders are gathering for that summit, North Korea now ramping up tensions by accusing U.S. spy planes of violating its airspace and threatening to shoot them down. North Korea claimed that drones and spy planes flew for 8 straight days along its coastline, with aircraft violating its airspace. The Kremlin spokesman says Russian President Vladimir Putin met with Wagner leader Yevgeny Prigozhin days after a short-lived rebellion by the mercenary chief and his private army. A Kremlin spokesman says it was a 3-hour meeting that took place June 29th and involved commanders from the military company that Prigozhin had founded. Congress is back in session after the 4th of July break. The biggest item on the agenda in the House of Representatives is the $886 billion National Defense Authorization Act, which conservatives are using as a platform to object to what they say is progressive social policy from the Pentagon. And the Senate Democrats on the Judiciary Committee want to work on establishing ethics standards for Supreme Court justices. And disgraced sports doctor Larry Nassar has been stabbed multiple times during an altercation with another inmate at a federal prison in Florida. He's serving decades in prison after being convicted of sexually abusing female gymnasts, including Olympic athletes. Sources tell the Associated Press that Nassar was stabbed in the chest and back yesterday and remains hospitalized in stable condition. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:40 on Wall Street. I'm Nathan Hager. Stocks are fluctuating. Bonds are holding on to some gains at the start of a week that'll bring key inflation readings, a slew of Fed speak, and the beginning of U.S. earnings season. The S&P 500's hovering right around the 4,400 level as a growing chorus of Wall Street strategists tell investors this earnings season probably won't fuel fresh stock gains. Rock Creek Managing Director Alethea Doriwala says diversification is key.
Growth is going to happen in particular niche sectors and areas. So we are investing quite a bit right now in alternatives. It continues to be very interesting. Investors can take advantage of those secular long-term trends. U.S., Europe, emerging markets. You see tailwinds from the IRA and climate infrastructure projects. You see huge innovation in AI. You see things happening in agriculture technology, healthcare, data centers.
We check the markets all day long here at Bloomberg. Right now, the S&P 500 is little changed, up 3 points, trading at 4402. The Dow is up 140 points. That's a 0.4% gain, 33,875. The NASDAQ is little changed to lower now, down 5 points at 13,655. 5 of the 11 main industry groups in the S&P are in the green, led by industrials and healthcare. Utilities and communication services are the biggest laggards right now. 10-year Treasury is up 6/32 for a yield of 4.03%. The 2-year yield 4.91. NYMEX crude is down 0.1% or 8 cents lower at $73.78 a barrel. COMEX gold is down 0.3% or $5.90 at $19.2680 an ounce. The euro 1.0968 against the dollar. The yen is at 141.78. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Madison Mills.
All right, Nathan Hager, thank you so much. We appreciate that. Madison Mills and Paul Sweeney here in our Bloomberg Interactive Broker Studio. And, of course, you can see us on YouTube. We are live streaming there. Just go to YouTube and search Bloomberg Global News, and you'll get our video feed there. Some fun stuff. Last Friday, payroll day, jobs day, came in a little less than expected, but I don't know. I think this job market's still ripping. I mean, the unemployment rate fell down to 3.6% from 3.7% last period. So that's about as low as it's probably going to get. I don't know. Let's check in with somebody who kind of does this stuff for a living. Kate Duchesne, CEO of RGP. RGP is a publicly traded company, and the symbol, coincidentally, is RGP, so you can put that into your Bloomberg terminal. Kate, what did you make of the employment data? What do you make of today's employment data? What are you seeing out there?
Well, we're still seeing a very strong labor market. Labor participation rates are still well below what they were in February of 2020, and we still think it's a talent market.
So you still think it's a talent market, but it doesn't necessarily feel that way, right? It feels like increasingly we're hearing CEOs and employers calling people back to the office. Do you think that the talent pool today has as much power as they did a year ago?
They might not have quite as much power, Madison, that they did a year ago, but it's still on balance, I think, a talent market. We are reading headlines of CEOs asking for workers to come back on site. It's in our experience, and we work with some of the largest companies in the world, it's still very much a hybrid environment, and that the employers who are demanding full-time return to the office are losing that battle and slowly moving backwards on that command. And that's what we see. I mean, talent has formed very strong opinions coming out of COVID about what works and what doesn't, and how much control and choice they want. And they are expressing that. And, you know, labor participation rates are one of them, because people are also moving into more gig work and making choices about what works for personal and professional blend.
How about a garden variety recession? Will that impact kind of maybe that balance between the workers and the employers in terms of coming back to work? Are you hearing that from any of your clients?
Well, I think everybody's still in a wait and see. We've been talking about this recession now for months. Yep. It's not here yet. In our client base, we still see clients holding back a little bit on starting new projects, waiting to see, is it going to get worse before it gets better? But I'll tell you, given how strong the labor market is, given the news we saw on wage inflation, it still feels like there's a lot of robust economic activity out there. Now, a recession might cause a pause. People tend to get more conservative in the face of real negative economic news. But remember, we're also seeing a change in demographic, and the demographic that's the majority of workforce now. And millennials and Gen Z have a very different relationship with work than baby boomers did.
Well, it's interesting you bring up demographics because I've been thinking about how the overall unemployment picture really varied across demographic lines, particularly when it comes to race, looking at Black workers accounting for close to 90% of the increase in jobless claims since April. Can you talk to me about what you're seeing in terms of racial disparities and differences when it comes to the jobs data and hiring?
Right. I do think it's, that's terrible news for us. I mean, I think that to have the African American rate so high is something that we need to work on as a country. We see it more in gender, really, than race, and that is that, women who have made different decisions coming out of COVID, especially when they bore the brunt of childcare, have tended to remain out of the traditional workforce in higher numbers than men. I think that's moderated a bit. But you do see populations of workers, again, making different choices and choosing to bring their skills to the market in different ways. It used to be it was either full-time employment or nothing. And today there's so many different choices about how you can earn a living and choose to bring your skills to the marketplace, whether it's gig work, independent work, and those choices exist now in ways that they didn't, 10 or even 20 years ago.
Kate, another kind of labor statistic we look at is the JOLTS number, the job openings. And that's a number that historically has been, 4, 5, 6, 7 million openings. And it's been running at 10 million, 11 million, 12 million. We're down to 10 million today. Are those people ever going to come back to work? Are they out of the workforce, do you think?
I think many are out of the workforce, but we also have a real imbalance in our labor force, given retirement demographics and also our immigration policy. So you really have to dig in what category of worker that you're talking about. But I think this imbalance in available work and available talent is going to persist. That's not something that's going away when recession worries going away. That's something that is going to exist for the foreseeable future. It's also one of the reasons that AI automation are going to be a good thing, not a bad thing for workers, because we have to find a way to fill in some of the gaps since we won't have enough humans to do everything that needs to be done.
Kate, 20 seconds here. When my friends ask me if they need to be worried about getting laid off in 2023, what should I say?
I think no. I think there's certain sectors that, we've seen tech for sure, but now tech hiring is coming back in the AI space. So I think labor is getting redistributed. And if you're good at your job and you bring relevant skills to the marketplace, you shouldn't worry.
Hey, Kate, thanks so much for joining us. Really appreciate it. Kate Duchesne, she's the CEO of RGP. We appreciate getting some time from her joining us via Zoom. But your friends, are they concerned about?
Oh yeah, totally.
Really?
Oh yeah.
Why?
Well, we talked.
Is all-time low.
I know, and we talked about this a lot on Friday with the divergence in the data. I think that regardless of what we're seeing with the numbers, the vibes are bad. We keep hearing headlines about a recession that's impacting what bosses are saying and check-ins at mid-year about salary increases. So it just feels a little scary out there.
Okay. All right. Good to know. Good to know. We'll see how that plays out. Looking at the markets here, again, S&P kind of unchanged here. And we have a Dow up about 0.4%, 144 points on the Dow. The NASDAQ off just fractionally, so not much going on there. We'll have more coming up. This is Bloomberg. Let's get at some company news right now with Steve Rappaport.
Paul, Meta Platform CEO Mark Zuckerberg says the company's new app rapidly reached a big milestone. More on that from Bloomberg's Lisa Mateo.
Instagram's text-based app Threads reached 100 million signups in just 5 days. It took OpenAI's ChatGPT bot nearly 2 months to reach that same milestone. But TechCrunch says keeping users on the platform will be the biggest challenge. Twitter has been losing users since Elon Musk's takeover, and changes to the app, including rate limits on posts users can read and adding a paid subscription service for verification. Steve.
Thanks, Lisa. Shares of Meta currently up less than 1%. Senate Majority Leader Chuck Schumer wants the FDA to investigate Prime energy drinks after health concerns from experts about potentially dangerous levels of caffeine.
Buyer and parents beware, because it's a serious health concern for the kids it so feverishly targets.
Schumer adding Prime drinks have so much caffeine they put Red Bull to shame. We're talking about a caffeine equivalent of about 6 cans of Coke. Company reps say the product clearly states that it is not recommended for children under 18. And never mind the beach. It's retail shopping that's what's hot in July. Amazon, Best Buy, Walmart, and Target are among the companies offering up sizzling sales this month. Data from analytics company Placer.ai indicates that while inflation has weighed on retail foot traffic in recent months, this month's sales events could mark a turning point for major retailers. And according to analysts, the gap between previous year's retail foot traffic levels and 2023 visits have narrowed in recent weeks. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Madison Mills and Paul Sweeney here in the Bloomberg Interactive Broker Studio. Looking at these markets, not much movement there at all. The S&P pretty much unchanged. Looking at the yield space here, yields coming down just slightly. The 10-year Treasury, 4.03%. We'll keep an eye on that. The 2-year, 4.9%. Crude oil steady right here. WTI crude oil, $74.10. That's pretty even for the day. Bitcoin, a little bit higher, a little bit of a bid out there. Now trades still above 30,000, about 30,300. So there you go for Bitcoin. Tom Keene's not here, so I can quote that. Right now, though, let's head down to Washington, D.C. We'll go to Amy Marge. She's got world and national news.
All right, thank you, Paul. A massive heat wave is building in the southern U.S. and will expand into the Pacific Northwest through this week. Temperatures in the Southwest could top 120 degrees Fahrenheit. Elsewhere, many states will still be in the low hundreds. Red flag fire warnings are already posted across Oregon and Washington state. Chief NASA scientist and senior climate advisor Dr. Kate Calvin tells CBS's Face the Nation the El Nino weather cycle is part of the reason the U.S. is seeing this record heat this summer, and that the change in climate affects more than just temperature.
It's also affecting things like the water cycle. So we're seeing more heavy precipitation events, more droughts. We're seeing increases in extreme events like storms.
Calvin added that El Nino years are typically warmer than La Nina years, although 2022 was the warmest La Nina year and the 5th warmest year overall. A GOP challenger and former ally of Donald Trump says the former president's campaign is for himself and himself only. Former New Jersey Governor Chris Christie told Fox News Sunday that Trump only wants to be a 2024 presidential candidate for one reason.
Trying to undo the loss he had to Joe Biden in 2020.
Christie once again called Trump a 3-time loser, noting that he not only lost to Biden, but Republicans lost the House in 2018 and the Senate in 2020. President Biden is headed to the NATO meeting in Lithuania. On the way, stopped in London, where he met with UK Prime Minister Rishi Sunak and took part in a climate engagement with King Charles III during his visit to Windsor Castle. Now, before leaving for the NATO summit, Turkish President Erdogan says his country might approve Sweden's membership in NATO if European Union nations open the way to Turkey's bid to join the EU. It's the first time Erdogan has publicly linked Sweden's membership in NATO to Turkey's application to become part of the EU. The president of Lithuania tells Bloomberg that's a new requirement. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Amy Morris, and this is Bloomberg. Paul and Madison.
All right, Amy Mars, thank you so much. We appreciate that. Well, we're going to get CPI later this week, and the headline forecast is 3.1%. That would be a big decrease from prior month of 4%. But if you want to get more kind of boots on the ground, Maddie, and look at something real, used car prices in the U.S. fell 4.2% in June from May. That's the largest drop since the pandemic began, and we're down 10.3% from the previous year as a key measure of inflation eases. So that's it right there. If you're in the market for a used car, prices are coming down.
Yeah, finally starting to come down. I wonder, though, to what extent that's just because the prices have gotten so high,
Yep,
right?
yep.
It's not like we're necessarily seeing that dip there. Another thing I'm looking at, though, on the car story, if only Matt Miller was still with you, Paul, electric vehicle sales growth slowing, and we're seeing a swelling of inventory for electric vehicles in particular. Right? So I'm wondering if that, slower pace comes as the supply of EVs on dealer lots in particular ballooned to 92 days.
Yeah, it goes to the question, and I have no idea what the answer is. Just kind of really, what is the real demand for EVs out there?
Yeah,
I don't know. I don't know. I test drove that Ford F-150 EV, and it was awesome. Incredible performance, incredible power, and I don't know, but I think a lot of folks. The early adapters were there. It's kind of a fun, cool, techie-driven thing. But the average American, are they really attracted to that whole EV concept? But if you listen to Detroit, that's where they're going.
Right.
I mean, you better get on board.
Well, and if you look at Rivian having just incredible growth on their 9th day of gains here, seems like the EV story is definitely here to stay.
Yeah, and that Rivian story just seems like the market said, okay, I think these guys are going to make it. It's had that light bulb come on for investors in Rivian that this could maybe be, another really successful EV story. So we'll stay on top of that. Ed Ludlow in particular is all over that news.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, push that blue button. All right, coming up in this hour, we're going to get some really smart analysts from Bloomberg Intelligence to join us here in studio. We're going to start off with Mandeep Singh. He's a tech analyst there for Bloomberg Intelligence. I want to talk to him about this whole Meta thing, this Threads. It's a thing, like 100 million users already. So that's a number that gets your attention. So we'll see what that means for Meta and for Twitter as well from a competitive standpoint. And then Gina Martin-Adams, she's a chief strategist at Bloomberg Intelligence. We love to talk to her about earnings. We got earnings season kicking off later this week, and we want to get a sense of kind of how she's viewing earnings season, how much maybe earnings risk is still left in this market for investors. But right now, let's kick things off with Nathan Hager and get a Bloomberg Business Flash.
Well, Paul, my eyes on the latest survey of consumer expectations from the New York Federal Reserve Bank. That just came out. 1 year inflation expectations decreased to 3.8% in June from the previous month's 4.1. It's the third straight decline, the lowest reading on inflation expectations since April of 2021. Of course, it comes before we get the latest read on consumer prices on Wednesday. Stocks are starting this week on a cautious note with that inflation data, the kickoff of earnings season, and a slew of Fed speak on the way. Some of that Fed speak includes one of the biggest regulatory overhauls for banks since the global financial crisis. The vice chair for supervision, Michael Barr, says firms need to standardize how they estimate operational risks rather than relying on their own estimates. He says the Fed's stress tests need to change as well to better reflect the dangers that banks actually face.
These changes would increase capital requirements overall, but I want to emphasize that they would principally raise capital requirements for the largest, most complex banks. We intend to consider comments carefully, and any changes would be implemented with appropriate phase-ins.
Fed Vice Chair Michael Barr laid out those plans in a speech in Washington. We're getting more Fed speak right now from Cleveland President Loretta Mester, saying the central bank will need to continue raising rates somewhat to make sure inflation gets down to the 2% target. We check the markets all day long for you here on Bloomberg. And right now, the S&P 500 is little change to the downside. 4398 is the S&P level. The Dow Jones Industrial Average is up 117 points. That's a gain of about 0.4%, 33,850. And the NASDAQ is down 13 points, a decline of 0.1%, 13,646. The 10-year Treasury is up 5/32 now, yield close to 4.04%. The 2-year yield is at 4.90. NYMEX crude is higher by 0.2%, up 14 cents, $74.01 for a barrel of West Texas Intermediate. COMEX gold is down 0.2%, or $4.20, $19.2830 an ounce. The euro 1.0981 against the dollar. The yen 141.65. Bitcoin's higher by about 0.25%, trading close to 30,300. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Madison Mills.
All right. Nathan Hager, thank you so much. We appreciate that. Madison Mills, Paul Sweeney here with you in the Bloomberg Interactive Broker Studio, and we are streaming on YouTube. You just have to go to YouTube and search Bloomberg Global News, and you'll get our stream, so that's good stuff there. Madison, just seen an email coming around from Simone Foxman, our buddy over at Bloomberg News, and she was just calling out some of the big retailers having big kind of like sales days coming up. Amazon Prime Day, which is I guess tomorrow and Wednesday. Walmart Plus Week is this week.
Yeah.
Target Circle Week, 9th through the 15th of July, and Best Buy Black Friday in July 10th through 12th. The retailers trying to get people to jump on board and start spending some money here in what would otherwise be kind of a pretty dull summer time for them.
Right. Well, and it's a really important bellwether in between some of the big earnings that we're going to get from these retailers. We don't start to hear from the Amazons and the Walmarts until much later in earnings season, obviously kicking off this week with the banks. So looking at some of these sales around Amazon Prime Day is going to be a good indicator of consumer health.
A lot of stuff out there to get the sense of the consumer here. Let's get a sense of what's happening with these markets, and the S&P 500 is absolutely unched on the day. Not much happening, but Katie Greifeld, she can tell a good story if she has to. She's our cross-asset reporter. She joins us here in studio. Katie, what are you looking at today?
We can talk about some single names. On the broad headline index, though, not too much to talk about. Of course, we're heading into a big week. This Monday morning, it hasn't started yet. Of course, the big focus is on CPI on Wednesday. It's really the last big meaty data point that we're going to get before the Fed's meeting later on this month. So we'll see what happens. It could explain why right now you see volume on the S&P 500 not too great compared to the 20-day average. And you are seeing a little bit of a bid into bonds, but the 10-year still hovering around that 4% level, which a lot of people said that it wasn't going to get to. So we'll keep an eye on that. Do you guys want to talk about Icon Enterprises?
I would love to.
This is a big one. So you look at the shares right now, they're up 15.7%. The reason why is that Carl Icahn, he's basically renegotiated loan terms with a group of banks. This is news because we know that Icon Enterprises, which is Icon's investment firm, it was hit with that short seller report from Hindenburg Research back in May.
Yeah.
Icon, the man himself, he's borrowed basically billions of dollars against his shares in Icon Enterprises. So there was some concern that maybe a margin call would enter the topic of conversation. So he gets some breathing room here. He's basically consolidated all his borrowing under a 3-year term loan, according to SEC filings. So you can see that relief in the stock. Right now, this is the biggest rally in about 2 months.
Whatever happened to that report, that short report? Has it been borne out at all, or has there been any update there?
Not really. Of course, every time Hindenburg takes a swing, everyone pays attention. In terms of what's going on specifically with the Hindenburg report on Icon, I don't believe that we've seen anything. Of course, they claimed in that report that the company is overpriced, that it found evidence that it inflated valuations. Icon's stance, of course, that is that the firm's performance would speak for itself over the long term, as it always has.
You know what I want to know, Katie, is do we think we'll ever see Carl get on Threads? Oh my God. Is that ever a reality that we can expect?
There's been over, 100 million signups so far. It's just been incredible. And Evercore, for its part, thinks that that number is going to double to 200 million daily active users over the next 2 years. So I don't know, maybe Carl will sign up, but we know a lot of people has. It's been incredible. You're on Threads?
Yes, and of course you are.
Of course I am, Paul.
I am.
You are.
I am.
Oh, good job.
Exactly.
Nice.
How about that?
That is breaking news.
Breaking news,
Redhead.
exactly.
Paul Sweeney is on Threads.
You know what? I'm just looking through the news here for this Icon. Just go back to that. Who's the banker for Carl Icahn? That'd be a good account to have.
That would be a good account to have. I'm not quite sure.
I'm just looking through. I'll get back to you when I find it, because I want to know which bank has the relationship. All right, what else are you looking at out there in the markets? Again, not a lot happening is on the index side.
On the individual side, we should probably also talk about Kava, of course.
Yes.
The IPO that kind of really caught everyone's attention because we haven't seen a ton of them. I've never been, actually. I've never been to a Kava.
What's wrong with all of you? I can't believe you don't go to Kava.
Where is it?
It's literally like the best bowl place in the entire world.
I'm not a bowl person. Like, I don't know what a
You're not a bowls
bowl
guy?
is. I'm not a bowls guy.
You don't like grains?
Do you just eat like a salad?
Yeah.
Oh, like,
I don't know.
Just throw some rice in there and call it a bowl.
A lot of people like Kava, though, especially in the stock market. Nice pivot there. Up 8.7% now that Wall Street analysts are starting to weigh in. The majority actually initiated coverage with a buy equivalent rating. So it's getting a lot of love from the street. And the basic thought there seems to be that Kava's focus on specifically Mediterranean food has a potential for a large market demand. So we'll see if that plays out. Current thinking is that there could be 1,000 units by 2032.
Wow. Man, it is tough. Imagine, having been in those shoes, being a research analyst and doing a lot of IPOs, if you'd come out with anything less than a buy, man, the pushback internally, even after they kind of got rid of that stuff, they separated research and banking, it's still there. So it's not surprising to see analysts come out.
You do have Citi. They
I saw that.
Yeah, came out with a neutral rating. So
Citi is so funny these days. Like the last Fed meeting, they were the only house to call for an additional hike, and like, what's up with them? I just feel like they always go
Independent
the opposite.
research. Independent research.
Independent
There you go.
research.
I used to work there back in the day. So
What's up with that, Paul?
Pretty much everywhere. Everywhere. I don't know. It's good news. You want to see some independence out there?
I guess, yeah.
All right, Katie Greifeld, great stuff. Thanks for bringing us up to date on what's happening in these markets. All right, we were just talking about Threads. 100 million users. That gets my attention. Let's see what it means for Meta. Let's see what it means for Twitter. Let's see what it means for just people's spare time, spending more time on social. I'm going to blame Mandeep Singh for all of that stuff. He covers the technology for Bloomberg Intelligence. He joins us here in our Bloomberg Interactive Broker Studio. I mean, Zuck comes on and says, gee, it was more than our expectations, 100 million signups for Threads. Does that number mean anything to you?
It does. I mean, look, this is the fastest growing app ever, and it surpassed ChatGPT, which was the craze so far.
Okay.
So I think clearly they have a great momentum, and what it shows is the creators are seeking an alternative here. I mean, that is really the crux of it, that everyone wants something that is similar to Twitter, where they can build their network, and they think this is a viable platform. Blue Sky, Mastodon, and the others didn't take off because they didn't have that scale.
Well, what do you make of the scale? And it's so funny, Mandeep, because on Friday we talked about how over the weekend we might get that surpassing of ChatGPT in terms of signups, and I think it happened like right after you got off the air with us. So you are a leading indicator when it comes to the Meta story. But why are they able to convert active users so quickly?
I mean, look, with social media, it's like you have those network effects, and in the case of Meta, they have the 3 billion users across their family of apps, right?
Yeah.
They can promote stuff on their app. Look at how TikTok grew back in the day. They were one of the heaviest advertisers on Facebook, on Instagram. In this case, I mean, Meta owns all these properties. So they can promote their Threads app. And right now, I feel they've gone with a very niche, focused approach, text-based format. They will keep layering, more photos, more videos on Threads over time. But what they want to make sure is there's a clear value proposition for Threads, and it doesn't end up cannibalizing Instagram or Blue App.
Well, that's a great point. Do you think that Threads is going to be a legitimate competitor to a TikTok?
I think so. Over time, I can see Threads having a messaging tab. So think of all the things that Meta does in terms of features. They're using a very narrow subset of that for Threads because they want it to rival Twitter.
Right.
Get those users on board and then iterate and add more features to drive engagement. And look, at the end of the day, it's about average time spent on the platform. So compare that Instagram average time spent, it's around like 70 to 80 minutes per daily active user. Twitter is around 25 minutes. And they tried to pivot to subscriptions too early. I mean, this is still an ad-driven model. And when in an ad-driven model, it's all about engagement and time spent on the platform.
I'm not buying it. Are you on? You're a threader?
Wait, why are you not buying it?
I don't know. How many of these do we need? But all right, let's go to the impact on Twitter. Is this a zero-sum game? If they sign up 100 million people to Threads, do you think a lot of them came from Twitter, or do you think it's going to be a zero-sum game here?
Absolutely. I mean, again, I go back to that 3 billion daily active users across the family of apps. That includes all the Twitter users. And for the 100 million that they have signed up, remember, they haven't launched in Europe. So it's just,
that's right.
That's right. Once you launch in Europe and they'll figure out a way to work with the regulators, they have the signups. In the end, it's always about engagement. That's what TikTok got it right, and that's why Facebook had to play catch up once they saw the viral adoption of TikTok. In this case, they have the signups. Can they keep up the engagement? And over there, the algorithm, the content recommendation algorithm matters a great deal, because what Twitter did wrong was they screwed up the algorithm. Right now, if I go on my home feed, I don't see any of the people I follow. I see feeds from people who are paying Twitter $8 a month. That's not what I want to see. And that's where I think
completely random content. Like, I'm
totally
only on
random.
Twitter for eco and finance news, and then I just see completely random tweets constantly.
Yeah,
so Threads has the capability to get that algorithm play back in, and also potentially get advertisers in who were spooked by Elon Musk.
Yeah,
So when are they going to start putting, as Madison's suggesting, when are they going to start loading ads on their threads?
I hope they don't do it this year. You really need the engagement going. Until the engagement hits like 25, 30 minutes a day per daily active users, I mean, it would be, I think, too premature to layer ads. And I really hope they don't do that.
So what else is this? I mean, the Meta story is up like a jillion percent, 140% this year, basically on cost cuts. I hate to ask what's next, but what's next here? I'm looking at the stock at $290. The all-time high was back in about 2 years ago in 2021 at $380. What's the bull case to get us back there?
Well, so think of why people became negative on Meta. It was because Blue App was losing engagement. They had to find the next growth driver for engagement. They thought Metaverse was the one. Obviously, that didn't work out. Now they have found something that can add to the engagement.
So where are we on the Metaverse discussion?
I think that's a side story.
It's over, right?
Really?
Yes.
But that was going to change the world, and
I mean, they still are selling hardware, but in terms of engagement, they're not getting engagement on the Metaverse app that they have created. So engagement is coming from Threads or what they're doing on Instagram.
Are we going to start to see a roll-off in Threads users as the parents get on there? That was one of the viral Threads posts over the weekend, that the parents are starting to come, and therefore it's not going to be cool in the next week.
I think ultimately it comes down to features and algorithms. Look, how engaging the algorithm is in terms of the content you're seeing, that to me is the key. Whether or not, you're seeing, that to me is the key. Whether or not, your